How's it going, everybody? Thanks for joining in. I'm just getting some things set up and then we're gonna get started here in about 30 seconds. Jump in the chat if you're new to this and introduce yourself. Thanks for the first like. All right, so I'm just getting this situated. It's my first time using the OBS system, which is like the live streaming system on this computer. So I had to set it up and try and get it back running again. But we've had a lot of good questions, a lot of great conversations in the last several weeks with this whole coronavirus thing going on. And obviously, if you're watching this right now, you guys have seen what's been going on with the stock market. Ironically or coincidentally, this is what I studied back when I was going through my graduate program, my MBA, going through my MBA program is value in companies. And so it's pretty relatable to what's going on right now. So we're going to dive into that. If it's kind of herky-jerky and the video or the audio is really bad, just let me know. I should probably bring this mic closer to my mouth so you guys can hear me. How's the audio, everybody? Let me know in the chat. Audio and video is good? Hey, Patricia. It's a good question. That's not part of the stock video, but Patricia, usually with those, the what's it called, the IRS portal, it is the day that it's mailed out. So if it says it's going to be mailed out on May 1st, you know how the government is. It could be, it's getting started. It still could be in the mailroom floor of whatever facility they're mailing out of. And then as of right now, you know, like it's obviously the weekend right now, it could be stuck in transit. So a lot of times businesses, it could take 5 to 7 business days for mail to get to you, especially through snail mail. So just because they say May 1st doesn't mean it's going to get to you May 1st, unless you have direct deposit. Somebody please help me. Can you guys hear me okay? Just write in the chat if you guys can hear me. I want to make sure before we get started and I go too far into this. Yay? Nay? All right, I'm going to test it myself then. Hang on 1 second. Can you guys hear me? All right, I can hear it. Let me switch this off. Oh, actually, no, that's good. Thank you, Grace. What's up, Jed? Okay, let's get started. So, as of, what was it, March, the second week of March, we had a huge stock dip. Let me take off this audio. It's messing up my rhythm here. Okay. So, as of the second week of March, we had a crazy crash in the market. And right now, everybody is kind of curious, is like, how come we had the worst, 10 days of the last 2-3 decades, and then all of a sudden April was the best month that we've had. And we all know that the economy is still shut down, and what's going on? Well, today what we're going to go over is I'm going to tell you exactly why the stock market is rallying back up and why there's a bunch of companies that are trading at peak levels, even though we all know that we are actually, for all intents and purposes, we are in a recession, and we're about to officially step into a recession come June 30th. And so how come companies are trading so high, and why are so many individual stocks, the market as a whole, it's doing actually really, really well? It has something to do with Trump, has something to do with $2.2 trillion, actually $3 trillion, possibly more. And then what I'm going to do is I'm going to jump into 2 stocks that I think are really, really interesting. I'm going to show you how I value them, maybe how you can value it too. And then at the end, or not at the end, but a little bit later on this video, I'm going to start taking suggestions, and I'll show you guys and gals how I look at stocks and how I was taught and how I valued companies, both in the public sector, and then how I value companies in a private sector when we're doing mergers or we're looking at buying out, or in most cases for folks like me, is how do we raise money and then how much equity do we give away. So if you guys have questions at any point in time, jump into the chat, let me know. I'll actually put that screen up right here real fast. And if you have any questions, feel free to ask. But I'm just going to keep talking and yakking away. If I get to a point where I don't make sense or you guys can't see something clearly, just write to me and then I'll address it. Okay, so first things first. Why is the stock market rallying right now? Well, obviously, in the second week of March, the market tanked because of obviously the shutdown. The coronavirus was spreading worldwide, and globally, everything just restricted. All countries were basically on lockdown for most of them, anyways. That caused severe panic. Everybody was selling off, and we saw huge dips in the stock market. Okay. I should probably show it up on the screen, but if you guys want to pull it up, just go pull up Google Finance or Morningstar. You guys will see that huge dip. And now it's rallying back up. And the reason why it's rallying back up is something called quantitative easing. And it's a strategy that's used by the government and the Federal Reserve. Something that to keep in mind is that the Federal Reserve is not necessarily the government. Federal Reserve is where all the money's made and what keeps our money system or currency, the dollar, in place. It's not controlled by the US government. There's a lot of influence back and forth, but they're not the same entity. So what happened was that the Trump administration and the Federal Reserve came together and realized what was happening, and to ease the pain of this recession that we all saw that was coming, and actually even before the coronavirus or COVID-19, there was actually already signs in the economy. And so what they did is, if you guys remember, the Federal Reserve dropped interest rates to zero. Okay, that helps ease it. And then the other, it's called QE, quantitative easing, is that they started printing a bunch of money and pushing it into the market to give us $1,200 checks, right? $500 for dependents. But what really happened was that a lot of that money, 75% of it, more, maybe even 85% of it, actually went to state governments, hospitals, small businesses, and corporations. And then unemployment was another big chunk too. But what we have to realize is that 75-80% of that $3 trillion went outside of, did not go directly to citizens, okay? And so what that does is that what I'm about to get into is really interesting, is how that money finds itself back in the market. And quantitative easing is set up so that you pick up the market. And how that works is by infusing a lot of money, and this is, I call it funny money because it's just printed, right? It's just like if I take a piece of paper and I like, okay, this is worth $20, here you go. Is basically what the Federal Reserve did on a different scale. And so what ends up happening is that you get $1,200, your sister, your brother, your mom, your dad, everybody gets $1,200 plus the $500 for their dependents, so for children or elderly grandparents or parents. And you use that to pay your landlords or your rent or your mortgage or whomever, right? And you also go out and you buy groceries, you might buy necessary supplies, all this stuff. Probably not too many luxury items being purchased today, but let's say the essentials are purchased. So a lot of times, like my renters, they pay me rent. I then turn around and I pay my mortgage or my lease agreement or whatever, my utilities. And then I go out, or you go out and you buy groceries or toilet paper for most or a lot of Americans. What ends up happening is that I use that money, I then give it to the bank, all right? If I have any excess, I put that in my bank account, or as you guys know, I put in the stock market. You go to the grocery store does the same thing. They take a small portion of it, it's called their profit, and then they pay their supplier, whether their supplier is a farmer or it's a manufacturer or whomever. The supplier does the same thing. They pay their people, they pay their suppliers or their distributors, and then they take a little piece of profit and they put it in their bank account. Now, what ends up happening is if I have any excess, I put it directly in the stock market. Any money that goes into a bank account usually ends up in the stock market because it's reinvested, right? So when you go to a bank and you give them, let's say, your $1,200 check, it doesn't just sit in cash inside a vault. It actually just is turned into numbers, zeros and ones, and then the bank actually has that money invested. And that's why you get an interest rate. So what's happening is all this money is ending up back in the banking system. And if it's not inside the banking system, it's ending up in hands like myself or other investors or entrepreneurs or normal folks, citizens, and we reinvest in the market. And so all of a sudden this huge cash infusion of 2.8 trillion, close to $3 trillion, it might be more now, is getting turned back into the market, sending, right, the stock market back up, even though there's no justification for those high prices, right? Right now we know we're about to step into recession, but because there's so much demand for purchasing stocks, the whole market goes up. All right, let's see if there's any questions. MacArthur, what's wrong with the title? What's causing stocks to rally? I value your picks. Disney versus Chipotle. MacArthur, tell me what's wrong with the title and I'll fix it. I think you fixed one of my other titles before. I really appreciate that, man. Thank you. XOM, I'll have to take a look at that. Jed, I'm not sure what XOM is. So anyways, getting back to my point here is that causes the market to bump up. Now, you also, if you go back and study every recession, we see this. And the reason behind this little spike up is people get eager. We think as investors, as individuals, we think that we missed the bottom. So everybody floods back into the market and we buy it, causing a supply and demand thing, right? More people want to buy something, the more people are willing to pay for something, the price goes up. That's exactly in the simplest terms of how it works at a macro level. Make sense? Okay. With that said, with the market going up, we know that we're not in a boom market. We had the longest economic expansion the last, 2009, so 10, 11 years. And we are well due for one. There's huge corporate debt. Our country is spending money and printing money freely, and we have our economy shut down. It's not just our economy, it's the world's economy. And so what ends up happening is that we get a lot of overvalued companies, and that's the purpose of what we're going to do today. And why we want to find overvalued and undervalued companies is because I'm a value investor. I'm not a speculator. I'll get into that. I am a little bit of a speculator, but I'm not primarily a speculator. I'm not a stock trader. I'm not a day trader. I am a value investor. And what I mean by value investing is that I invest in core companies that on a whole, they do very, very well. They have sound businesses. I'm not looking for like the next Uber, Lyft, Tesla, Airbnb, IPO that I think can make it big within 2, 3, 4, 5 years. The reason behind that is because a lot of these IPOs or these private companies going public, they have no cash flows. They have no sound business. They haven't been tested in a recession or a bad market. Companies like Johnson & Johnson, Microsoft, Google kind of, but I mean like companies like that, staples within our economy, Coca-Cola or banks like Bank of America, they've been tested and they can prove these cash flows and they have sound management for the most part. Okay, so let's dig into it. The two companies that I got for you is Disney and Chipotle, and I'm thinking if you guys like this, I'll do this a lot more often. I've already done about maybe a dozen or so companies officially, and you'll see how I do it. And then towards the end, I'll take a look at some of the companies that you guys want me to look at. All right, so let me get this sorted out here. Hey everybody, if you guys just jumped in, you guys can rewind it a little bit, and if you guys want to see my explanation of why the stock market is rallying back up and how it's not very sustainable. And then I'm about to dig into two stocks right here. I'm just going to share my screen with you so you guys can see it. And then I'm going to remove this, remove the annoying white crosshairs here. Oh, whoops, I don't want to do that. All right, so I want to do DSLR, boom. All right, good folks, hang tight here. I'm just changing this so you guys can see my screen. Boom, can you guys see that? I'll move this down here. All right. all kind of blurry now, isn't it? I'm sorry about that, folks. There you go. Okay. Jump over here. ExxonMobil. Oh, yeah. Chipotle is spelled wrong. Oh, thanks. Thanks, MacArthur. I'll change that right now. Man, MacArthur is always spell checking me and grammar checking me. Chipotle. Chipotle. Yeah, just got rid of that autofocus. Sorry about that. Again, first time using this in a long time, so I apologize. Okay, everybody see the screen? Is the text large enough? I'll increase it here for you guys. All right, so the first one we're going to look at is Disney. And how you do it, how value investors do it. And I took this from, it's nothing that I created by any means. It's something that I learned in school through my MBA program. It's something that I utilized after my program when I did consulting for a little bit. But it's the most common. It was made very popular by Warren Buffett, right? And basically what it is, very, very surface level, is you're valuing a company based on its core. And that you don't care what the market says. You don't care what analysts say. You are basically seeing if what is the intrinsic, right, the value that you place on that company, and you purchase it because you believe it's a good value. So a good example behind this is that, let's say that we all know that Teslas are pretty well-valued vehicles, right? Let's say brand new Tesla Model 3 is like $40,000 before tax breaks. Now, if I came to you and I was like, hey, there's a brand new 2020 Tesla Model 3 that's on sale for $20,000. 0 miles, you can go pick it up at the dealership right now. Would you go buy it? You probably would, because you know that it's valued at $40,000, right? And so that's the same thing that you're doing with companies, is that you find a company and you're like, hey, there's this great company that usually that is valued at, let's say, valued at $100 a share. Right now, because of the market, because of the economy, the recession, the government, whatever, the market has really beat it up and it's only valued at $50. And people like Warren Buffett, they go in there, they don't just buy a few thousand shares. They usually go in there and buy huge chunks of the company. So they own 8, 9, 10, 20, 30% of the company if they don't just buy out the whole company. And essentially that's what shares are, what stocks are. When you buy a share of a stock, you're actually buying a small ownership of a company, 0.00001% of a company. And so what I do here is I calculate that intrinsic value based on the financials, based on a few assumptions that I have to make. And we utilize those numbers to generate an intrinsic value. And then we take that intrinsic value and we compare it to the marketplace. And then from there, we can decide, is it time to sell or buy, or potentially wait. Okay, so I'm going to start with two companies today, and then I'll jump into what you guys want to look at, and I'll show you guys how to do this yourself. All right, so the first one is Disney. Disney is, I'll go through the numbers first, and I'll explain to you what I think about Disney and why it's a little bit tough to analyze right now. Okay, so the first things first is that Disney right now it's trading at $108.15. It should be right around there. I think it might be actually 105. Actually, I do think it's 105. Let's do 105 right here. I can actually check that super fast. Walt Disney is trading at, 105.50. So let me trade this. Okay. So it's undervalued right now because it's trading at 105.50. I believe, based on my calculations, it's worth 137. Now, the market may not agree with that. That's just a long-term. I'm looking out long-term. Overall, if I'm planning on owning Disney for a long time, I believe a fair value price for Disney is $137. It's like the $40,000 Tesla that you can get on sale right now for like $36,000 or something like that. So what you do to do intrinsic value is very simple. On this spreadsheet, I know it's super confusing, and I know that it may look really complicated. It's not. It just looks way more intimidating. if you haven't seen financials before, okay? And believe me, I'm not a huge, super great numbers guy, and I've learned to do it and be really, I've learned to be competent at it, but I'm definitely not a natural at it. So everything in green is what I'm responsible for putting in, okay? And so right here is the first box. This box is usually called assumptions. Or correct data that you have it. So real quick, I know the current stock price. You can find that anywhere. I usually use Morningstar, or I use Simply Wallet. And then you do the current PE ratio, and I use this. This is just information for myself. And then you start digging into understanding how much cash the company has, how much debt they have, the number of outstanding shares, their tax rate, average debt or average interest on their debt. And then the really big one for folks like us is you need to determine a discount rate and an EBITDA multiple, which I'll get to here in a second, okay? Remind me if I forget. So from 2015 to 2019, these are all numbers that you can just basically pull from any financial website. So if I go to morningstar.com and I type in Disney, whoops. There you go. I'll come to here, and I'll show you guys how to do this real quick. So to get to financials, it's super easy. I just typed in the quote, clicked on Disney, and you get all this, right? You can see the chart here. If you want to track and see what's going on with the company, it'll open this up, and you can see basically day to day. You can go out to the year, and you can see that Disney was trading at like 145, took a huge dip down to 85, 86 bucks, and now trading at 105. What we're interested in is the financials. And so if you go to financial tab right here, you'll get all of this. It still looks crazy, messy, intimidating to me. Don't worry about it. And down here, you'll get the income statement, balance sheet, and statement of cash flows. Those are the three things that you need. And all I'm doing is I'm taking those three and I put it in here. Okay, that's all I did. All of this right here is basically copy and pasted. All right. Now I had to copy and paste a few things differently, and I'll make a video on more detail of how I do that, and I'll show you as an example when I actually do this for one of your guys' companies. But essentially, I just want to understand the core business. When you do intrinsic value and without spending days, and you can literally spend days, weeks, months analyzing a company, you want to do a simple method. You want to do it quick and fast, but as accurately as you possibly can. And so that's what I did. I copy pasted the numbers in here to understand just the core business. There's a lot of fancy engineering of financing. What's it called? Accounting ninjas or accounting engineering, accounting, something like that. Basically, where they mess with the numbers to make it look all weird. I want to bypass that, so I pour their core numbers and I look at operationally how well does the company do. Okay, so this right here. It's called unlevered free cash flow to the firms. And this is probably the most important number for analyzing a company. And what it does is it tells you that if you were a business, how much cash is your bank account going up by each month, each quarter, or each year. That's all I'm trying to figure out. So right here, what I did was after I got rid of all the noise and the nonsense of those crazy financial sheets, is I found out how much free cash flows is going to the firm each year. So from 2015, they started at, these are all in billions, okay? So big numbers here. 10 billion all the way up to 13.67 billion in 2019. They had a great year last year, or 2018, I'm sorry, of almost 20 billion, right? Now our job is when we're trying to figure out the intrinsic value is that we have to forecast out. So I'm forecasting out 5 years. It's a very standard way of doing it. Sometimes people do 6, 7, 8, all the way to 10 years. But remember, the longer or the further out you go, the more difficult it is to forecast. If I was to ask you to forecast out the next 5 years of your life, it would be kind of difficult, but you could probably do it, sort of. If I ask you to forecast out the next 10 years of your life, it just gets a little bit murky, let alone like 15 or 20 years, right? Okay. So that's all I did. And how I do that is it's called common sizing, okay? And common sizing is you take the revenue of a company and you divide their expenses or their profits all by that revenue to give you a percentage, okay? So for example, right here, let's take 1 year. Let's just look at 2019 for Disney, okay? So let's just look at the areas in green. 69.57 right here is the revenue. So basically almost $70 billion in 2019 is the revenue. So that's going to be our denominator for Disney. All right. And we're going to common size everything to that revenue. And so the first thing is COGS, which is cost of goods sold. And cost of goods sold is just basically what it sounds like, is like if Disney sells you a Mickey Mouse, the cost of goods sold that's for that stuffed animal is how much did it cost them to make it, how much did it cost for them to ship it, and then how much did it cost them to actually sell it to you, okay? So their cost of goods sold for their $70 billion was about $42 billion. I come down here, I figure it out, it was about 60%. That's it. You just take 42 billion divided by 69.5 billion. You get about 60%, all right? Which gives me about 39.5% gross profits, okay? Now, what I do is you just do this. You just keep doing it. So the next thing that I did was SG&A, which is Sales General Administration. Again, trying to keep it simple. I tucked in R&D, which is like research and development. I tucked in some other expenses in there, whatever is in the income statement. I tuck it in there. So it's just overall, like, you got to think about like their salaries, people in the headquarters, people who get paid like security guards, people like that don't directly relate to the selling of their product or services to the business. Okay, we got to take out those expenses. So we take that out, common size it, and we see that's roughly, last year, it was roughly about 16.5% of their revenues. Okay. Now you keep doing this. I'm not going to go line item by line item and put you guys all to sleep. But what I do next is then I forecast, or I basically make an educated guess of what those percentages would be for future years. Okay. Now, if I have some insider knowledge, or I'm making educated guesses, or I read their annual report and I know, like, I'm going to make this up. But let's say that I know that Disney is making, they're buying the last Avatar. All right. Okay. The Airbender. And they are going to make a huge theme park over Avatar: The Last Airbender. If I know that, and I know that they're doing it in 2022, I know they're about to sink a lot of money then, right? Which means that their cash will go down and their debt will go up. You can take that into account, but we don't know that. So what we'll do is we'll common size things out based on what we know, or in this case, what we've seen in the past. And so all I did is right here, if you guys can see my cursor, is I looked at their previous 5 years of cost of goods sold, or COGS, and it was roughly around 55%. Don't ever take averages. Never, ever take averages. I say never, but maybe sometimes I have. You usually want to take the median, or you want to take the previous year. That's probably the most accurate, but then you usually want to take the median. So here's like the 55%, and it doesn't have to be exact. When you're dealing with numbers these large, it's important to be as close as possible, but you'll drive yourself crazy trying to get exact. Next thing is SG&A. I looked at the last 5 years. It's around 15%. Taxes. I looked at their taxes. They pay about 20%. This is a really weird area too, because they have teams of accountants and tax lawyers. They're companies at this size. They're looking for every reason not to pay taxes. Again, it's not tax evasion, it's tax avoidance. That's okay. So what ends up happening is that they'll find loopholes, legal ways of getting around paying full taxes, which is usually around 37 to 40%, sometimes a little bit more, a little bit less, depending on the state that they operate in. But you can see here with Disney, they fluctuate anywhere between 9% up to 30%. So I had to find just a stable middle of the line, because I don't know what they're going to do or what they're going to write off the next year. So I put 20%. You do the same thing for depreciation, CapEx, working capital. You just kind of work your way down the line, which gives me all these projections over here. Okay. Now, based on all of that, I can then value the company off of their cash flows right here. All right. This is what we value things off of. This one down here, if you guys are looking, is free cash flows to equity, okay? And free cash flows to equity takes into account debt, which is super important, because your free cash flows to the firm, I know this is getting kind of confusing, is like how much money you take in. So like say that you're working for, you make like $60,000 a year. After taxes, you take home about, what is that, like $3,500, $3,700 a month. If you have $3,700 a month and you pay all your bills and everything looks good and you get a pocket, like let's say you get a pocket $800 a month. That's awesome. That's your free cash flow to firm. But let's say that you now have a personal loan that you have to pay. A personal loan and you have car payments. Okay? That costs $900. No, let's do that. Let's say it costs you $700. So now you have to pay those loans, that debt. So now you only actually pocket $100. You see, those are two different numbers. So the free cash flow to firms, you make $800 or you take home $800. Free cash flow to equity, you actually only keep $100 because you have to service your debt. That's the same thing for companies. So right here and right here, we use this to value the company, the free cash flow to the firm, because we just want to see operationally how strong they are. This is to see if they can survive, right? Because I really want to know if they can survive. So to jump back up here to discount rates, we're looking at the discount rate is super important in the sense that you're gauging the risk of a company. I've talked about this in previous videos, but I didn't go too in depth because just like how I'm saying this to you guys right now, but I know it sounds more confusing than it really is, and I'm probably not doing an excellent job explaining it. So ask questions if you guys need to. Is the discount rate is the risk that company holds, or the risk of projecting out or investing in that company. And typically the base of it is inflation rate. Okay, so what's inflation? And then you usually tack on what you can get in the safest investment. Okay, so usually that's bonds, certificate of deposit like a CD, or like a money market account. Okay, so typically right now, inflation, gosh, we don't know what inflation is. Inflation is insane right now, right? So, or can be insane. But let's just say like inflation is usually about 2%. And then right now, even the safest bonds are like near 0%, under 1%. But I usually just use 1%. So you're at 3%. That's your base, okay? So in the safest company in the world that you are basically almost guaranteed your money, almost 100% guarantee, you give them like a 2 to 3% discount rate. Does that make sense so far? And then every percent above that is a risk premium. Basically, how risky is that business? How risky are they? How risky is it in projecting their future cash flows or their sales, their total gross revenues? Okay, so for Disney, we'll get into the details here in a second, is that I bumped it up about to 8%, which is actually not that crazy high, but pretty high considering the environment that we're in now, which we'll get into here probably in the next like 4 or 5 minutes. And then the EBITDA multiple right down here is EBITDA is just this line right here. All it is a fancy way of saying earnings before interest, taxes, depreciation, and amortization. Okay, it's profit, folks. It's profits after you take out expenses. So after I take out the sales, the salary, the administration, and I take out the cost of selling the goods, you get profit. Okay, it's a different type of profit. It's called, what was it, gross operating profits, I believe. It's but it's EBITDA. In business, you call it EBITDA. And what you do is you do a multiple of that. So in business, and giving us some like inside baseball knowledge, inside baseball secrets of business, is to quickly value a company. Let's say that every single one of you had a lemonade stand or some sort of business, and I had to quickly value it. I didn't know your expenses. I didn't know anything. I would do a quick multiple calculation. Sometimes it's off revenue, usually it's off profits, or EBITDA in this case, okay? Because the reason why you don't do it off revenue is if you made $1 million a year, but it cost you $900,000 to make that $1 million revenue, it's not really indicative of what your true profits are, right? Versus if another one of you made $1 million a year in sales, but it only cost you $200,000 to make that $1 million in sales, you have a better business. But on a sales level, you make the same. You guys get the difference? Okay. So that when we do multiples in business or in the stock market, it's just saying how many years out can I continue getting that getting that profit? Okay, so when somebody gives you a multiple, or they talk about multiples of 5 years, 5 times, right? They're basically saying, I believe when I buy your business, I can replicate your revenues or your profit 5 years. Does that make sense? So for private businesses, like let's say you and I or any of us, we have like a dog grooming company or like something like that, or a car detailing company. You usually use 3, maybe 5 years if it's super solid, okay? In a publicly traded company, the average or the baseline is 8, okay? 8 times. So 8 is the baseline. Anything that's really, really bad or a really kind of volatile company, maybe 5 or 6, okay? Anything that's super great, you go maybe 9, 10. All right. So you can obviously see that for Disney, I gave it a 12. And the reason why I gave it a 12 is Disney, you pay a premium for their name. They are in many, many markets. Again, we'll get into that in a little bit here. And 3, it's like Disney has been a staple since like what, 1950s, 1960s? So you can, or I can, this isn't you, I can argue that a 12 multiple is actually really in line. And there's probably some people that would even give it a higher multiple because it's such a strong brand and such a strong company. Okay, so with that, those are the 2 fundamental things that dictates the intrinsic value. And so when I use that, I figure out this intrinsic value to the firm right here. All right, it's $285 billion. What we then do is we take out the debt that they owe, because it's like if I wanted to sell you Disney and I say like, hey, it's $285 billion, give me monies. You're like, well, you have a bunch of debt in the company. You have $47 billion in debt. I'm not going to give you $285 billion to take over your debt. So what you do is you automatically take out the debt, okay? So you take out the debt, but Disney also has 6.8 over almost $7 billion in cash, right? So you got to add back in the cash because we're trying to figure out the value of this company for stockholders like us. So you take out debt, take out cash, tax shield. I'll get into another conversation because that gets confusing. It's nothing too crazy relatively. It's still $250 million, but there's a tax shield in there that you add in. And then you get this IEV, intrinsic equity value. That's the value that we are interested in. That's the value for stockholders like us, okay? We take the $245 billion, we divide it by the number of outstanding shares. This is all can be found in these 3 sheets. This would be in the balance sheet. And that gives us a price per share of $137.50. All right. It's currently trading at 105, which means that this is undervalued. Okay. Now with that said, who knows? FU bear. It is very hard to value something in this environment because no one knows what the new normal will be on the side. Absolutely right. But we can try our best with cash flows. So with the 137.50 versus the 105, we can see it's undervalued. I spelled undervalued wrong. But okay. Let me just fix that. The under. It's gonna bug me. There you go. Okay, is that I probably will not buy this right now. Actually, I know I won't buy it right now, even though it's undervalued. And the reason behind that, but Warren Buffett would probably do something totally different. He'd probably be buying loads of this right now. But I'm not telling you to do that. I'm not a financial advisor. I'm trying to educate you on how to look at these, okay? And the reason behind that is because I know and I believe that the stock market's going to go down even more. I'm not the type to tell you to try to time the market, but we're so close to a cliff or a drop off. It's not worth risking buying a bunch right now at 105 to have it go down to 60, 70, or 80, just like it did, what was it, 4 weeks ago? So it's not worth it. I'd rather wait to see what happens, especially if there's another stimulus round, what happens during election season, all this stuff. But what it tells me, though, is I now have a number of 137. So every time that it ticks down a little bit further, I know that I need to start buying into it sometime soon, okay? This is basically what it's telling me. But right now, it's about, based off my numbers, and we can play with these numbers. Let's say that we gave it a less of a multiple. We gave it a 10 multiple, and then we get a discount rate of closer to like, let's say 10%. It's still, that's right on point. So that's right in line with what the current trade market price is. 106 versus 105. That's almost identical. That's amazing. But I like the 8%. I like the 12 times multiple. Okay, this is the thing with the hey, what's up, Irma and Gonzo? Sorry if I mispronounced that. is that Disney's a very interesting play, because what happens is I don't just run the numbers. I actually dig into the news behind Disney, and I go to, it's really simple. Any company, you just type in whatever company, Disney investor relations, and it'll pop up with this, right? And you can dig into all their previous reports. And so for Disney, there is a lot of information about their business, their cycle, what's happening with their parks. And what's happening with this coronavirus right now is that their parks are shut down worldwide. Okay, I think they're slowly opening in China, but basically all the parks are shut down. The studio, like Marvel Studios, their movies, they're not releasing movies. I think the Mulan that was supposed to be released here pretty soon is pushed all the way back to July now, and the next one after that is not Scarlet Witch. What's it called? Black Widow is now due in November. 2 movies, which I don't think will do really well, personally. And then with ESPN, their other arm, their media arm, is that there's no sports right now. So they're just trying to push out a bunch of content as everything is shut down. Their only saving grace right now is Disney Plus. But let's take a look at that real quick. So in the next 2 to 3 months, the parks and their cruises makes up about, what was it? It's right here. So their parks and their cruises makes up about $6.6 billion. Okay? Now, this is interesting because this is the quarter, their summer quarter, where it's peak traveling season. So it's going to be a little bit higher. Really, they make about roughly half of their revenue from their media networks. So think Fox and like their Disney Channel and ESPN. That's where the bulk of their money comes from. Okay? And then a smaller portion comes from studio. Can you guys see this screen? Yeah, you guys can see this. And then another bulk comes from direct-to-consumer and international stuff. And this will include Disney Plus. Now, we know that parks are basically eliminated. For Q2, Q2 was through June, possibly through Q3, there's basically not going to be any cruises or openings of Disneyland, Disney World. Maybe, but it's going to be a much lower capacity. And you got to remember, they got to abide to social distancing. And people probably won't be going to Disneyland when they're in the middle of a recession, they don't have jobs, and they're afraid that they might get sick. So you got to think about it that way. ESPN, the media networks, may continue to do just fine, but if there's no more sports or there's no sports for the foreseeable future, we don't know what that's going to look like. And then with the studio and the movies all got pushed back. So they are literally releasing movies directly onto Disney Plus. Okay? That gets me to another thing. So 3 of their 4 arms are basically handcuffed. And then now with Disney Plus, it's actually a saving grace because I think as of, last week, they had over 50 million paying subscribers. That equals, at $7 a month, that's $350 million a month, which is about, how much is that? 350 million? That's a month? What is that? A year. How come my math? 4 billion a year, right? Yeah, $4 billion a year, okay? So that kind of makes up a little bit for everything, but it's still going to be a loss for them for the year as a whole. So we got to take that into consideration. When we're looking at this. So with that all said, this is what's going through my mind when I'm valuing companies, right? I valued it at about $137. They're currently trading at $105, but I know the next 2 quarters, they're going to get hammered. They're going to get hammered so hard. On top of that, we know we're stepping into a recession. So if I was like, hey, dude, Kai, the smart thing to do is to buy put options, bet against Disney because they're going to get completely hammered. They're going to get get hammered the hardest. So you could make some money if you bet against Disney. In the long run, though, Disney is a win. Okay, they're just too strong. But right now, this coronavirus is like the perfect storm for them to basically wipe out their profits for the next 2 quarters. Okay. Weird. DraftKings had their IPO. I gotta look that up. DraftKings? I can't believe they released an IPO. DraftKings. Huh. They're not coming up. I'll take a look at it later. Okay. Any questions about Disney or what I did? No? Okay. Let's jump into the next one I'm looking at is Chipotle. So we just had one that was undervalued. Let's take a look at one that's overvalued. So I did the same thing with Chipotle. And Chipotle, as you can see right here, is trading at about $880 a share. Doing my calculations, doing the same thing, common sizing, it's coming out to be actually closer to 360. Even with the margin of error, let's say that my numbers are totally messed up, I did a wrong assumption somewhere. Even if you give myself, if I'm wrong by a magnitude of 20%, Chipotle stock is still significantly overvalued. And we saw this in the last dip when they dropped all the way down to like $500 a share. I think it's like 520 or 530. But now they're back up to 900. They're one of the most overvalued shares or one of the most overvalued companies right now when you look at their numbers. And the reason is we're not comparing them. Like, I know that they use great products or great ingredients, even though they got a bunch of people sick in 2015 or 2016. I know they have great brand. I know they treat their customers and their employees really well. The thing though behind it is that you have to look at the books. It's how much cash and how much value they give the stockholders, investors, you and I. Just because we really like Elon Musk, we like that Tesla or electric vehicles and they're good for the earth. You're not going to pay $200,000 for an electric car like what they used to cost, right? You're not going to do that. It's not valuable to you. You don't put that much value in it. You would pay maybe $30,000 to $40,000 for one, right? Now we're started breaking. How many more people would buy it for $20,000 to $25,000? It's the same thing with the stock. Even though it's a lot of investors during our boom period valued Chipotle, wrongly so, for $900, a more moderate, a more accurate value for the stock is actually closer to $400 a share. Okay, completely based off of their actual cash flows, and their cash flows are right here. And I'll dig into this, and then we'll move on. Is that they range like right around between 120 million to about 250 million, and I'm being generous to them and saying that they're not going to get hit by the coronavirus that hard, and they'll still bring in between 300 million to 460 million dollars in unlevered free cash flows for the next 5 years. And their stock price is still only valued at $363 a share. Okay, very, very overvalued, and there's a lot of opportunities there if you are risky enough to short it or buy put options, which I would never suggest to anybody if you don't know what that is or how to do that. Don't ever go invest on margins or play with shorting or options unless you actually know what you're doing and you're willing to lose all that money. Okay. With that said, any questions about Chipotle? Let's just go comments real quick. Rarely do you want to buy pure put or call options unless you're willing to take repeated full losses and make it up on one win. Diagonal spreads are a better strategy. Yeah, you're right, FU Bear. It's if you want to what's it called? Not diversify, but yeah, you want to spread out your risk. I totally agree with you. But just playing with options, I believe. I don't know what I wonder what you think, but just playing with options is just super dangerous because, like you said, you're basically making a bet that you think that a stock price will go up or stock price will go down, and it's a bet. You don't actually own anything. You own a contract, but if that bet doesn't play out right, so let's say that I know that I fully believe that Chipotle will go down in value. I make a bet that Chipotle or a put option will go down by Q3. Okay, so I put in a contract that I bet it'll go down by October. If Trump all of a sudden decides to release another $3 trillion to pump up his campaign and a bunch of more money floods the market and it doesn't go down, but it finally goes down in December, I'm out that, probably $10,000 bet thinking that Chipotle would go down and it didn't go down by October. I lose that $10,000. And then it finally goes down in December, I make no money. Even if I was right, my timing was off, so I lost money. Very important. Okay, let's take a look at a company, and I'll show you how I do this. For the folks that are still in here, this might get a little bit kind of cray-cray. So if you guys like numbers and you guys want to see how I actually value a company, I'm going to do it right now. So if you guys have any questions, ask me before I jump into the numbers. All right, what company are we going to do? Jed, you want to do ExxonMobil? All right, I'll do ExxonMobil. So one thing that I want to make sure that we do, I take a lot of what I learned from my program. So my program was led by basically Harvard MBA professors and Harvard, Stanford MBA professors and students. They come from a very much more traditional value investing way. And so I invest in companies I experience and I understand. I won't go out there and invest in something that I've never experienced or understand. Like, I don't know banking. Okay, I don't know banking very well. I might invest a little bit, like 2% of my portfolio, maybe just for dividends. But I won't I won't buy puts, options, or invest a large amount of my money in banks because I don't understand them. I don't get them. Chipotle is a simpler business in the sense that I understand restaurants. Okay, I understand. I say that a little bit of tongue in cheek. Okay, I don't understand them. I never ran a restaurant, but I understand the basics of them. I can't understand them. I know their product very well. Whenever we go in there, we've analyzed them as a case study in the past. Home Depot, I understand. I've been working with Home Depot for a number of years, both as a contractor, as a personal projects. I know all the stores in my area very well. Things like that. I only invest in businesses I understand. So Exxon, I do not understand, but I can run the numbers for you and show you what to do. Okay, and then it's your job to go in and dig into their 10K or their quarterly statements and their shareholder meetings, and to dig deeper and see what's going on. Does that make sense? Okay. Oh, Nike! I want to do Nike. I know Nike a little bit better. Manuel, I already did Home Depot. I'll do Home Depot in a little bit. Okay, I'm gonna do Nike first because I want to do Nike. I grew up next to Nike, and then I'll do Exxon next one. Okay, Jed. Jed, are you still in here? Jed, let me know if you're still in here. Okay. Let's jump into Nike. So we'll start a new thing here. Is my face too big on this? Here, I'll make this smaller so you guys can see me. Or you can see more of the screen. Boop. Okay. So I'm just gonna go Morningstar. I'm typing in Nike. I think Nike is NKE, right? NKE, Nike. Boom. We'll pull that up. So I use Morningstar, and the other thing that I use, which there's a free version right now, it's called Simply Wall Street. Here. It's really, really cool, really, really fun. It's a great way to check your work too and get some insider knowledge. Not insider knowledge, but you guys know what I mean. All right, so I'm gonna go down here. I'm gonna copy this. Create, move to end. Nike. Today's the 3rd. It's important to date all of your analytics so when you go back to it, you can see what date you analyzed it because things do change. Let's change that to Nike. All right. You guys ready? Let's do this. All right. So first things first, we're going into Nike. I just typed in Nike into Morningstar. The first thing I go to is where is it? Valuations. I look at their current price to earnings ratio, which is 31.56. I come in here, I type it in, 31.56. I look at the current stock price. I should have done that first when I was on the screen. 85.54. And then now I want to look at how much cash and how much debt they have. And so I'm going to be looking at their balance sheet. And you guys will get this. You guys watch this enough and I do this enough times for you guys. You guys will start seeing where the numbers are. It's only in 3 sheets. Again, don't be intimidated by the sheets. A lot of companies, a lot of people lose money because they get intimidated by the sheets. Don't be intimidated. They're dumb accountants who make things way more difficult than they should be. I'm just kidding. I love accountants, but you guys know what I mean. Okay, so I go to my balance sheet here. I'm just gonna scroll up, scroll over, and then so I'm gonna go down to see how much debt they have. So how much debt do they have here? You scroll down. I'm looking for long-term debt. Boom. And then let's see how much current debt they have too. Total current debt. I'm gonna scroll over. Oh wow, they're giving me 2,000. What? Why they skip a year? That's weird. I've never seen that before. They skipped 2 years. They skipped 2014 and 2013. Unless they just mixed up the numbers here. That's strange. Okay, I'm gonna make an assumption that they messed up the numbers here somehow, because they're missing 2014 and 2016. I've never seen that on Morningstar before. Okay, but if I go back down here to debt, so current debt, total current debt, and then where's their long term? The long term debt's what we're really curious, but they actually don't have that much. They have They have 3.46 here, and then I'm going to add that with their current debt of 0.01, which isn't that much. What did I say? So 3.47. What's sketchy? Manuel? That's not sketchy if you want to watch the recap. Come back, watch the recap. All right, next thing I want to take a look at is the cash. This is super important, especially in times right now. You want to see how much cash and liquid assets the company has. Liquid assets is short-term investments that people or the companies can get out of. So for you, it'd be like your cash in your bank account, stocks, anything that if I said tomorrow, go pull the cash out, you can do it. That's liquid assets or short-term investments. So right here, they have $4.66 billion, which you can see, I'm also looking at a trend. It's been going down by about, what, $1 billion the last 3 years. That's not a super great sign, but. All right, outstanding shares. We go back, we're still on the balance sheet here. What is going on with this? How come everything's so inaccurate? They don't have anything for 2019? That's 2019, right? Yeah. Okay, so thank you, Nike, for showing all this. Sometimes numbers don't look great. That's why you need multiple sources. So I think it's 1.6, but I'm going to jump over to this other site, and we are going to go down to the bottom to ownership here. And we're going to see how much, or no, company information. 1.56 billion shares outstanding. Where am I? 1.56 billion. Tax rate, average interest, we'll take care of that. And then now before I start digging into the company, I don't want to be swayed by the numbers that I see. So for discount rate and EBITDA multiple, remember we're trying to guess how strong this company is. I grew up literally next to Nike, and I went to school in the whole area of Nike. So I know Nike very well. I know a bunch of people that work at Nike. And I grew up with all Nike gear. Doesn't mean I understand the business, doesn't mean anything like that, but I'm very familiar with the brand. So the discount rate I'm going to give Nike, if the baseline's 3%, I think a very generous, I think I'm going to give them 6.5% discount rate. Oops. And this number right here is basically the PE ratio that I'm giving the company. So by me giving them a 6.5% interest rate, I'm giving them a 15 times PE ratio. The market right now is currently giving it a 31.56 PE ratio or a 3% discount rate. So right now what the market is saying is that Nike is a guaranteed 100% for sure thing win, okay? Which I disagree with. EBITDA multiple, they're super strong, well-branded company. I'm going to give them a multiple of 11. All right, we'll see how this goes. Remember, baseline for public companies is 8 times. Great companies, good companies, 10 times. Great companies, 12 times. I'm going to give them an 11. Okay, they're a retailer. They're going to get hurt a little bit. There's not a lot of like their Nike outlets, the Nike Town, Nike stores. Those aren't as popular, and there's just so much competition these days. With that all said, Nike is still a very well recognized brand. It dominates sports, so I'll give them an 11 times multiple. Okay, let's dig into the numbers. So we get in here. Hey, what's up, PK? Thanks for being a fan. Hey, Gen F. There's a Gen A and Gen F. Man, you guys are picking up some of my favorite companies. Okay, I'm doing Nike right now, and then we'll take a look at another one. Nike's being weird because it's skipping months or skipping years. Okay, it has to be the what is it? The website, because here now it says 2015 to 2019. Okay, so now all I'm gonna do is I'm plugging and chugging. Okay, you guys remember plug and chug from high school days? I'm gonna take this and I'm just gonna start plugging it into this green. So you guys don't hear me talking, you just hear me working away. That's all I'm doing. Okay, I'm gonna move this mic so I have room to type. All right. I know what you're saying. I could download it into or export it into Excel and then just copy and paste. But you know what? I've done that a lot, and this is actually a little bit faster because I have to format it and then it downloads all in billions, and so I have to, it's nicer for me just to do it this way. But back in grad school, we had to do that all the time. All right, so we did that, and then we go down to SG&A. And you guys can see what I'm doing here. I'm just going down the lines. I'm just plugging, chugging. And then right here, so I already did the cost of goods. I already did the revenue. I'm going to go down here to SG&A. I know you guys can't see it all. I know what it says, but if you guys just pull this over, you guys can do it. You guys can follow along, too, on your laptops or your on your computers or your iPhone. And so right here you see general and administrative. So a lot of times companies will always label this, or they'll line it up differently, right? Sometimes they put it all under SG&A. Sometimes they break it up with R&D. But right here, Nike, how they did G&A, general administrative, and then selling and marketing. They split up. That's nice, because if we want to dig in deeper and see like, hey, where they're spending, why they have a huge spike in selling or marketing, we can see it. But all I'm going to do is I'm going to add that up, or they already added up for us right there. So we'll go back over here to SG&A. We'll do negative 9.89, negative 10.47, negative 10.56, negative 11.51, negative 12.7. Delta Airlines. Yeah, Delta Airlines, I won't invest in airlines. They're too difficult. I mean, I might do a put option, like a short put option, maybe put up a couple $100, but Delta Airlines, yeah, I don't think they'll. Even Warren Buffett won't invest in airlines anymore. I have a utopian vision of coding a data scraper with Python, maybe next year. Of coding a data. Oh, damn. When you said data scraper, I was thinking skyscraper. I'm like, what? Yeah, if you can do this, I mean, some companies have done it. FU Bear, if you go to Simply Wall Street, it's basically what they did. But man, if you can do that, let me know. I'd love that. Okay, now we're gonna get into depreciation here. Let's see if they don't have depreciation here. Depreciation, how much they spent on depreciation is gonna be on the statement of cash flows. Okay, so we're gonna go over here, open this up, boom. You guys see it right here. We're gonna scroll over. They really didn't have much depreciation because if you think about it, they probably don't have a ton of machinery or equipment. They're an apparel company, so that's nice. If you guys have any questions about any of this stuff, let me know. Okay, 0.65, 0.66, 0.72, 0.77, 0.72. All right, now we go into taxes. Taxes, we got to jump back into the income statement, and we're going to go take a look at provisions for income tax right here. Laid out perfectly. Income taxes, doing the same thing. 0.93, 0.86, 0.65. So right here, this is a great example. Hang on, let me get this last one in. You guys see, and I'm going to highlight this right here. Boom. You see how it just has a huge spike up in taxes? Something happened that year. So if I really want to dig into that, I can dig into that later. Anything that looks unusual, I usually highlight it so I can dig in and see what happened. I don't know if they had a huge write-off. I don't know if they took a bunch of losses or something happened with the taxes or something. But why did their taxes increase by, what is that, 4 times, 3 to 4 times than usual? That's not right. I mean, we're talking about billions of dollars. They go from $650 million in taxes to $2.4 billion in taxes. It's a huge spike. So we'll dig into that later. Depreciation is all good. CapEx is capital expenditure. So whenever I know Nike has been building a massive, building out their headquarters and then bought a bunch of land. So let's see what their CapEx is. And CapEx is in cash flows. You guys remember my previous video, I talked about this. So we go down here. Right here, purchase of property, plant, and equipment. It's right under cash flow for investing activities. And so let's see, if we scroll over here. You know what? It's probably not going to be super high because I bet you they pull it all out in debt, which we'll see here in a little bit. Okay, purchase of property, plant, and equipment. We'll just plug and chug that in. .96, 1.14. Hey, Michael. It's potentially I will set this up where you guys can use it, but right now it's just something that I use, and the formulas are kind of wonky. So if you plug something in or you don't know how to use it, it's really tough. And so before I hand it out to you guys, I might fix it up and make it a little bit more easier. And I might give it to you guys for free. I might sell it. I have a I have a personal finance spreadsheet that I sell for I think it's $2 or $3 on Etsy. I might throw this up there too. We'll see. I'll play around with it. If you guys really like it, then I'll make it available. But right now, it's just something I'm still playing and toying with. I just recently put this together as a template from this last recession. Okay, so going back to changes in working capital. Changes in working capital is super important. And the reason behind it is because it will, for major companies, I've seen it when I've gone into companies, they're like, man, I know I make a lot of money. I know that our sales are higher than ever, and we're fulfilling sales. Customers are paying us. I don't know why my bank account is going down $200,000, $300,000 every single month. And I was like, I guarantee you it's working capital. Working capital in the simplest terms, and there's obviously a lot more levels to it, is inventory, accounts payable, and accounts receivable. Okay, inventory is basically what you hear. So to make this iPhone, right, they have to have inventory of the metal cases, the glass, the buttons, the chips, the board, all that stuff. That's all inventory. They have to buy that. Accounts payable is if I'm a business, you're my supplier, and you give me inventory, I then have to pay you money. But a lot of times, if I'm a really good business partner of yours or a customer of yours, you might give me terms. You're like, hey, Kai, don't worry, you don't have to pay me for 45 days, so a month and a half. I'm like, awesome, okay. That's now my accounts payable, okay? Accounts receivable is my customers. I sell this iPhone, like 1,000 iPhones, to a customer, to a store, all right? I now give them terms. I'm like, hey, you guys are good customers. You just bought 1,000 iPhones from me, 30 days. You don't have to pay me the money for the iPhones for 30 days. That's account receivable, okay? Between those three and a couple of other things, but those are the three main ones, you have working capital, and it fluctuates, okay? So the more inventory that you buy, the more cash you have to pay out, right? Like same thing with your accounts payable, accounts receivable. They fluctuate a lot. Good companies know how to manage their working capital so it doesn't go all over the place. You want it as close to flat line as possible. Obviously, there's going to be some valleys and some peaks and stuff, but you want it kind of going down the middle. And so what we see here, what we see here is working capital is also known as operating capital, is that they are okay, right? So it fluctuated up 260 million and then it dropped 1.6 billion and then it drops another 1.14 billion and then it goes up 1.5 billion and then it goes up another 560 million. So usually in good companies, it fluctuates right in the middle. These are pretty big swings, but they're not crazy big. Okay, for a company this size, it's okay. I give them like probably B minus. All right, working capital. Also operating capital. Total changes in operating capital is what you're looking for. So 0.26, negative 1.58, negative 1.14, 1.48, and 0.56. All right, and let's do interest payments, which is back on the income statement. We go over here. Now, this is the interest they're paying on their loans, right? They have to pay monies to have those loans. Okay, so they are paying right here, which isn't too crazy. It's still a lot of money, you guys think about it, right? They're paying each year 30 million in interest, 20 million, 60 million, 50 million, and 50 million. And then principal payments, this is on the statement of cash flows. So for those loans, how much are they paying towards principal? Just like your mortgage, you pay a little bit of interest, you pay some principal, and then you gotta remember, in business, you don't have super long terms. Your terms for loans is usually 1, 2, 3, 5 years, maybe 7, maybe 10 years. So they have to pay these loans back. So let's see how much. It's usually under repayment of loans. So right here, repayment for lease financing. That's not what we want. Here we go. Repayment for long-term loans. Oh, they actually don't pay a lot back. That's all for leases. Let me open this. What does it say? Proceeds from issuance. All right, so they're not paying back a ton of their loans right now. They're paying back about 10 million a year, right? Yep. So right here, I'll put in negative 0.01. Where am I? I just lost my place. Right there. They paid 110 million that year. Paid another 40 million. Paid another 10 million. And then the last year of 2019, they paid another 10 million. So what that tells me is that they will probably in the next couple years have a big payment. Somewhere in the next 5 years, they'll probably have to pay a large chunk back to their $3.5 billion debt. What's up, Big Up Penguin? I haven't seen you in a chat for a while. I prefer index funds will make up roughly, by the way, I don't own any stocks right now. Again, I'm not telling you guys what to do. I don't want you guys to do what I'm doing. Everybody should be doing what is most comfortable for them and where their risk tolerance is. My financial situation is very different, so I'm playing things differently. I sold all my stocks last Friday, even my shares of ETFs, index funds. But typically 60% of my money, maybe 70% of my money is in index funds. And then the rest, I play around with stocks. Playing around with individual stocks is very, very dangerous. Even for me, at a lower level of expertise, very low level of valuing this stuff, it's still kind of dangerous. In the long run, I'm up. In the long run, I've done really, really well. But individual stocks, all it takes is think about how many billions of dollars got wiped out from Elon Musk tweeting just, what was it, on Friday? He tweeted that he thinks Tesla stocks are too high. He wiped out $12 billion, right? That one time that he smoked on Joe Rogan, it wiped out like, what was it, 20, 30 billion? I forget how many billions of dollars, but it wiped out a bunch of money. So stocks can be dangerous, but I do like them, right? Especially if I invest them in the long term. Or in my case, I like put options in circumstances like right now. What's up, Petra? FU Bear. Sorry, guys. I'll get back to this here in a second. I am answering these questions. Kai, the trend up to now for corporate America was to borrow money very cheaply. Absolutely. Through bond issuance and buy back stocks to float equity price. So that money's just gone now with the drop. FU Bear. That's a good point, FU Bear. So for folks that don't know what he's asking, so basically when interest rates drop really low, it's to entice companies, people like you and I, builders, to borrow lots of money. Because if we can buy a house right now for 2.5% for 30-year fix or 15-year fix, it's like, why not? I remember I bought up my first place for like 6%, which is more than double. So what companies do is they borrow really, really cheap money, like a couple of percentage points, right? And then what they do is they buy back their stocks. And what it does is it reduces the number of stocks out in the public. So then it inflates their stock price, right? So it's like if there's less number of stocks out there, it'll be worth more. Think about like the diamond industry or gold or anything like that, right? If there's less of a supply, it's worth more. What FU Bears brings up a good point is that they borrowed all this money to buy back stocks, and then now their stock prices go up, but then the recession hits and the prices go down. To answer your question, that money doesn't just go away. They still owe that money. Whoever they borrowed it from the bank or from another company, or whomever they borrowed it from or they issued those bonds to, they have to pay them back, right? So whatever that percentage is or whatever they ended up doing, they still have to pay it. It just sucks that they do that. That's why companies that do stocks buyback, it's really dangerous. Unless it's like Berkshire Hathaway where they actually buy it back because they see it as a wise investment. They're not actually doing it to float their equity price. Okay. Keep the numbers at the Morningstar window. Oh, okay. I'm sorry about that, PK. Here you go. I'll move this. Where can I move this? I'll make myself even smaller. There you go. Thanks for letting me know, PK. Oh, Manuel, he got in so much trouble for that tweet, man. He got in a ton of trouble for that tweet. He's actually getting, he might have legal issues because the SEC, they don't play around with that stuff. It's like if you are let alone the CEO or is he CEO? No, he's chairman now, right? Whatever. He's a leader within the company. Every time he gets in trouble, I feel like he loses a position, he gets demoted, and then he makes a few more $1 billion. But yeah, they're going to do an investigation, and they might fine him and might even have some recourse for that tweet. MB been off YouTube for the last little bit. I was focused on finishing. Oh, you're finishing up exams? Got it. Okay. All right, back to this here. Where was I? Okay, interest payments. We got interest payments in. Tax shield. So tax shield is this. Do you guys know how you guys, if you guys have a mortgage and you pay interest on that mortgage, you don't have to pay, that's a tax write-off. It's the same thing for companies. They get a write-off their interest rates. So the tax shield here is just calculating that. I haven't put in a tax shield rate yet. I will do that in a little bit. Again, it's an assumption. It's not exact because if we want to get more exact, we can dig into the numbers, but it's not going to be so monumental that's going to throw everything off, but we want to get it in there. Principal payments, obviously already did that. And then now we're going to look at the common sizing, okay? So we go down here. Oh, wait, I got to put in debt. Sorry, guys. One more thing. So we're going to go back in here. Let me make sure that you guys can see the numbers. I'm going to go back to the balance sheet. Go down here, and let's look at their debt, how much debt they had the last couple years. So 121. 1.21, 1.08, 3.47, 3.47, and then that's good. Debt didn't go up. 3.46. Okay, so debt did not go up. So the last 3 years, debt hasn't gone up. And you guys noticed, look. It went down exactly the amount of money that they put into it. They might have a revolving line of credit though. Let's see if they have a revolving line of credit. We should probably put that in there, their current debt. They do have a little bit of current debt. All right, we got to add that in real quick. So we'll do equals plus, what's the first year? 0.12. 0.12. This is probably painful for a lot of you folks out there that are really good at Excel. I apologize. So all I'm doing right now for you folks that missed it is I am just updating the information from the financial statements, and I'm just plugging into this very simple calculation that analyzes a company and gives me an intrinsic value of their core operations. Nothing too fancy, but far better than anything else that you'll probably find on the internet, unless it's an expert professional investor. Again, only value investing. Does not work for any type of speculating or any type of day trading. This is strictly for value investing. Okay, so we got everything in here now. Now we go to common sizing. We compare everything to revenues. Okay, so we go down here. You can see that Nike is very well established. They've been around since the 70s. And everything is very consistent. Take a look at this, right? Growth rates, revenue. This is the growth rate right here. You guys can see this? Yeah, you guys can see this. Is right around 6 to 7.5%. Great, well above inflation or current inflations. Their COGS is right around, what is that? Median is probably 55%. Awesome. So what I'm going to do with that is I can now put it in here and I can make some assumptions. We know that they're going to get hit hard by this recession, right? Retailers are just going to get hit hard. People aren't really going out looking for new kicks or new shoes, new warm-ups. Sports is shut down. Everything's on pause. And so they might not, if they were expecting to grow at like, say, again, 7% this next year, let's say that they grow, let's give them something a little bit more modest. Let's give them a 2% growth rate. The next year, they might pick it back up again to like, let's say 5%. And then let's give them another year of 5%, and then they recover and they're at 7%, okay? We could be off by 1% or 2. We can play with that later on, but let's just give ourselves a baseline right now. The next thing that we want to look at is their cost of goods sold. We can see right here that their cost of goods sold, common size to revenue, is always roughly, let's say 55%. So we're going to go in here, we're going to do negative 55%. Okay, drag that across. Next one is SG&A. We look at SG&A. I'd like at 2%, and it'll jump up to 17, and it'll jump up to like 58, and go down to 0. And it's really annoying. But this one's easy. They're almost identical from the last 2 years. So let's just be a little bit more conservative, and we'll give them 3%, negative 3%. Now working capital. You can see right here, you can see that they were negative, right? It's when it goes negative, it means they bought a ton of inventory or their accounts receivable went up, which means that they sold a lot of product, they gave it to a lot of customers, and they said, don't worry about paying me for X amount of time, because they're getting rid of something, but they didn't get cash in, okay? So that means that their cash went down. And then these years when it went up, it means that their customers paid them. Either they got a lot of it or their inventory expenses went down. They didn't spend that much on inventory. All right, so they're kind of, they go back and forth, so we can account for this. So it looks like they are 4%. So if we go with this trend of 2 years of negative, 2 years positive, we can play with that. Let's just do that, okay? They fluctuate. They have one heavy year and then one light year. So we'll just stay with that. We'll do one heavy year, one light year, one heavy year, one light year, one heavy year, like that. Whoops, not that much. Remember, I always say this in business is that what we're doing right now, we want axe-like precision. We don't need to be scalpel yet. Scalpel is when we dig into the 10K or the annual report. But right now, we're okay just seeing, are they undervalued or overvalued? Principal payments. All right, so principal payments right here, they are paying roughly a very small percentage of their dues. And so we don't know when that debt is due. So we'll have to dig into that later. But let's assume that we don't, they won't have to pay that for another 5 years. Okay, so we'll stick with the normal amount. We'll do 0.3, negative 0.03. We'll drag that across. And then we're going to assume, gosh, if times are tough right now, they haven't picked up any more debt ever since 2017. I believe that totally makes sense. They probably pulled out $2.5 billion for their new headquarters expansion. They're almost done, I believe. I don't think they need any more, so I don't think they're going to be pulling out any more debt. Let's assume they're not pulling out any more debt. Okay, so we're just going to take this straight across. 3.47. Well, actually, we're going to do this. We're going to make the assumption that they're not going to take any more debt. We're going to take this minus, can we do this? We can't do that. Because this, see, this is where it gets kind of funky. Let's say that they do 3.5. Yeah, okay. That's fine. We'll just do this. Bring that across. Boom. 3.47. I always have to clean this up, otherwise it bugs me. And then what I should do is actually be subtracting out the previous year. Let's see if I can do that. Minus this. I'll pull that across. Is that not working? I'll have to play with it. But you guys know what I'm saying, right? As I got to take out that point. I got to take out that 10 million that they're taking in each month, but these formulas are tied together. Michael or whoever asked earlier, that's why I don't want to put this out yet, because I have to fix this formula so it pulls automatically. But we'll keep with this right now. 10 million, when you're talking about several billions, it's not that big of a deal. So I'll actually highlight this so I come back to this later. Okay. That's it. And then all this does is it tells us that, nope, something's wrong here. What happened? Did I mess something up? Depreciation. That shouldn't equal that minus that. This should equal. Did I click something weird? I should equal this, that. There you go. Now we go back through and check our work and check our formulas here. And I'm trying to take a look and see. Taxes haven't gone in yet because I haven't put the common size number for taxes. We look at taxes here. So this is what I'm talking about earlier about fancy accounting principles, is that they go from 26% down to 16% up to 65% down to 14% again. So there's something funky going on there. I'm going to take, goodness, that's an outlier. I'd say if I kept that year out, I'd say they float around more than 20%. So I'm going to go in here, 20% tax rate. I can look at their average interest on their debt. Last year they paid 1.44, 1.31, 1.58, 1.74. They're floating around the same area. I'm going to go in there and I'm just going to say they're going to pay 1.6%. Fills everything out. And now, let me double check all this and make sure I got it right. So the first thing I look at is I look at unlevered free cash flows, and they're slowly growing at basically from like 18, 19 billion all the way up to 25 billion. Why is mine dropping off at 16 billion here? So I'm just going to go back through and check my work real fast. So there's something going on here. The depreciation's messed up. Oh. What happened here? Why did I put 55? I put negative 55%. What's going on? Depreciation. Oh, my formulas got messed up in something. That's why. Okay. So something happened to my formulas. I'm not sure. I'll have to check that, but they were pulling from the wrong cells. See? I'm really glad I didn't send this thing out to you guys. You guys have been getting bad valuations for everything. Okay. So depreciation, that's way better. How come I didn't catch that earlier? 55% is freaking ridiculous. Okay, they're closer to 2%. Come on, F you, Bear. You should have caught that for me. All right. Something still looks off. What looks off? SG&A. SG&A is 55%. No, SG&A is, it's 32. Sorry guys, hang on. Let me fix this and I'll start talking here in a little bit. I want to make sure these numbers are right for you. 5.19, 4.39, 5.4, 5.6, which was at 5, 7, 17, 18, 5.1, 5.4, 4.3. So depreciation is growing at 2%. It's growing at 2%, 2%. It's a little bit higher, but that's fine. 4.39. Taxes is roughly about the same. 39. Unlevered free cash flow takes a pretty big hit here. Why does it take a big hit? Oh, because of working capital. Okay. Okay. All right, so we're going to assume that these are accurate right now. So we can, what I was basically doing is I was just going back through and checking my work. Somehow my formulas got mixed up over here and kind of threw everything off. I'm not quite sure how that worked. And then something got messed up here when I was common sizing. So I had to fix the formulas for the depreciation to make sure that it was more accurate. It was showing something way insane that was not accurate. I was just randomly subtracting two numbers. Okay, so with that all said, we are looking at it being Nike being overvalued by about 96%. So almost double in value. Now this is something that's been something that's been very common when I'm valuing companies. Is again, don't take this as exact science. We did a very axe-like precision here, so I could be off by about $10 to $20 per share. But what it's basically showing is that it's overvalued. And if you check in with like any professional investors all over YouTube, Raoul Paul's a good one, Warren Buffett, Charlie Munger, they'll all say the same thing, is that our market right now, or not right now, but go back 2 months, was significantly overvalued. One of the highest overvaluations based on a lot of different calculations and what do they call it? Signals, is that the overall market, people were overvaluing companies by an insane amount. And so that doesn't surprise me that right now Nike is still overvalued. If I had to guess from the very beginning, I would say that Nike would be closer to $50 to $60 a share. But based on the numbers right here, I'll probably have to go through and tweak this a little bit more. It'll show that it was... it would probably show that's closer to 55. But let's check our work. Let's see how right or how wrong I am. Okay, so I'm gonna go back to here. This is this company, or this site called Simply Wall Street. I'm not affiliated with them in any way. I actually just like them. You can go and take a look, and they pull analysis Oh, so they're up there too. Okay. These are professional analysts. My brain is fried. Analysts. So they're saying a fair value is at $82. So let's see what they did to get to $82. The way that I could get to $82 based off this stuff is if they think what messes with that is growth rate and then these two numbers right here. Okay? I'm going to have to assume that these common size things are going to be the same because they'll probably see the exact same things that I saw right here. Okay? So if they're saying $82, let's just play around with this and let's just see that real quick what we can do. So discount rate, let's say that we drop it. It's at 3% right now. Let's say that I drop this to 4%. I mean, let's say that they say Nike is such a great brand name. It's been around forever. They give it like a 13 multiple. That takes us up there. And let's say that they say that gives a nice, decent growth rate because it's been growing consistently at 6 to 7% each year. Let's say that they went up to like 4, 6, 7, and then they did like 7 through the rest of the year, or for the rest of the time. That still gets us only to 60%. Or, $60 a share. So I would not agree with these analysts, right? Even though they're professional analysts. Keep in mind, just because an analyst says something, they're wrong a lot of the time. And I always run my numbers way more conservatively. So they might see something, they might know something that I don't know. Again, we didn't dig into the 10K or the quarterly earnings or anything like that. But right now, I would say that Nike is overvalued. Now, what that means is if Nike tanks, which it will tank pretty soon in the next market recession. I don't know if that's next month. I don't know if it's next summer. But if it does tank and it drops below $57 or possibly even $50, I would say that's a good time to buy. That's right around what it's valued at. It's the equivalent of you getting, knowing that a Tesla costs $40,000 and then Elon Musk is like, hey, everybody who wants a Tesla can come buy it right now for like $36,000. You're like, oh, it's a decent deal. Okay, let's look at these questions. Yeah, numbers are tough. Charts are nice too. That's why I like this Wall Street. How long have we been on here? Dang, we've been live streaming for an hour and a half, you guys. Okay. Bill Gates' software sucks. His vaccines are no better. Been watching this dude since July. Hey, $7 beats. Thanks for coming by. I appreciate that. Juggernaut, I appreciate that, man. Or girl, I really do. Yep, you were right. All right, what do you guys think? Should we do another one that I'll speed through and do less talking and see? Or should we call it? Let's see. I gotta get some water, hang on. And what questions do you guys have for me? You guys just saw me kind of do a really ad hoc one on Nike. Let me see what I think about Nike. Would I invest in Nike? Earnings grew, highly volatile. What do I like and what I don't like about Nike? Let's see. I like that they have enough cash to pay off their debt if they had to. I know that they are expanding their headquarters, but I don't think that's a great time for right now because they did pull out $2.5 billion in debt to do that. Or I'm sorry, was it $2.5 billion? Yes. Yeah, $2.5 billion. $2.65 billion in debt to do that. But let's see, like their cash flows, it covers their interest payments. And if they had to pay all that debt back, they can do that with their cash reserves. Cash flows look strong. I think I have to adjust. There's something going on with my cash flows for 2020. It doesn't look right. Overall, I think they're a good company. It's just that right now, retail is going to get hit really, really hard. And I think they need to tie up their working capital. Their working capital is, it fluctuates too much. It's hard to, it makes it difficult to analyze a company or forecast out when their working capital fluctuates. I mean, you guys got to remember, these are billions of dollars. It fluctuates between historically it fluctuates between 1.6 billion negative and 1.5 billion positive. That's a $3 billion fluctuation. It's like that's hard to forecast. So I had to forecast that in for the next 5 years, that crazy fluctuation. So it does hit their bottom line, but I feel pretty confident in my numbers here. Yeah, I'll have to dig in later. So, okay, what other questions do you guys have? AMD, Manuel, you keep asking about good companies. I already did AMD and HD, Home Depot. All right, Petra, what did Petra say? I got maybe 30K coming in. I'd be a fool if I didn't ask for suggestions on what I should do with this money during such a pivotal time. Petra, that's good that you have 30K coming in. It depends on... Actually, Petra, let's do a quick experiment here. Give me a little bit more insight if you feel comfortable. You don't have to if you don't want to. But give me a little bit more information on your situation, your financial status, your work, all this stuff, how much you spend each month. It doesn't have to be exact, just a rough estimate. And I can give you a better answer on what I think, what I would do if I was in that situation with $30,000. For everybody else out there, typically, is like you want to buy when things are on a deal. So in this case, let's take that my word as gospel. Okay, let's just make believe we're in this fairy tale world where everything I say is awesome. Is that so? Nike is valued at $58 a share. If the next recession hits, when the next recession hits, if it goes down to $40, I'd be buying into Nike every morning that I woke up. I check the price. If it dips, I'm buying. The further it dips, I'm buying, because I feel confident that the fair value of the company is at $57 or $58. Okay? You do that in the long run and you hold on to these good companies, core companies with good leadership. Again, we didn't dig into that yet, which we should do before we buy into it. And let's say that I did do that, I'll just keep buying in. The same thing with, what did we just do? We did Disney, right? Same thing with Disney over here. I'm valuing the company at 137. The only reason why I'm not buying into Disney right now is because I know that there's going to be a recession coming in and it could dip down even more. It was just valued at $78, $80 2 weeks ago. I don't want to buy in now for 105 and then have it dip down when I can get in for cheaper. And especially when I know the market is going to eventually catch up to what's really going on in the economy. So if I had $30,000 or with my money, that's exactly what I'm doing. I'm valuing these companies to see which companies are the most overvalued and which companies are the most undervalued. So when the market hits, after everything burns out and I see these companies, if Disney drops down to $50 a share, guess who's buying Disney, right? I'm probably not going to be buying Disney until I see the next big drop. But even if it drops down to $80 and it continues to drop down to 50, I'll buy all the way down and I'll buy all the way up, because I believe that Disney is valued right around probably $120 to $140. That's a fair value for it based on what they can produce in the next 5 years. Does that make sense? Okay. GNC, all right. FU Bear, do you have emergency funds? Yes, I do. I think it's very important to have emergency funds. You should only invest in the stock market with money that you have left over. Okay, you should have your expenses covered. Minimize expenses. I've pushed this to you guys so much so, is minimize expenses and then invest with anything that you have left over, and then make sure that you have a security blanket. I always recommend at least 6 months. So if your monthly expenses $2,000, let's say $3,000, okay? You should have at least $18,000 saved up, tucked away. And it's not for a new car, it's not for vacation. That $18,000 goes untouched, okay? And then everything above that, I like to have a huge buffer. I'm very different. I have, right now, I just have a ton of cash stashed away with a bunch of liquid assets, because I want to be able to jump into this market, okay? And I'll probably be jumping into it pretty soon. I'll probably show you guys me buying some stocks and put options in a future video. But yes, emergency fund, absolutely. I have zero debt. I say that with a little tongue in cheek. The debt that I have is all 0% interest rate. So if I always have the cash to buy something. So for example, I'm remodeling my home. I'm actually doing the whole outside, which I'll probably do a video on it too. I'm remodeling the whole outside and I'm redoing part of the house. I was able to get a 0% interest rate through Home Depot. I just have a good account with them, and I called them up. It's like, hey, can I get 0% and no payments for 24 months? They're like, sure. I'm like, okay, here, I'll buy it. So I bought that. So I have that. I bought this iMac. I was gonna buy it cash. They offered me, I think it was 18 months, no interest. So I used that. So other than that, not really. No, I don't have any debt. Do I own a house? Man, you're asking a lot of questions. Yeah, I own this house. This house right here. I built this house. I thought you knew that. I made a video on it. I built this whole house, and it's mortgage free. So I don't owe anything on it except taxes, right? All right, Petra. Back to Petra, my dear Petra. Unemployed, single, not much for expenses. Don't have to worry about living expenses. Pretty much ready to invest the majority of this income. Disney would be a nice part to own of. Yeah, so Petra right now, if you're currently unemployed and you don't have steady income, I'd warn against investing a lot in the market. Okay, especially right now, things can be really volatile. And so if you had more of a steady income and more in savings, I'd say start putting a part of it in there. But if right now you really want to get involved with it, I'd say find a couple of undervalued companies. Wait for the prices to drop and then slowly buy into them when they fall below what they're valued at. Another great way is a lot of beginners. What I recommend is don't buy into individual stocks. Buy into index funds. I talk about this a lot. It's a DIA, VOO, and QQQ. Those three track the three major index funds. And so if you wait for the next dip, or even if you want to start buying in right now, I wouldn't really recommend. I personally, I shouldn't recommend. I shouldn't tell you guys to buy anything. Don't buy anything. I would probably wait and buy into those three index funds in the next probably 3-4 months and just sit on it. Being a good value investor is just being patient, right? Even when everything's going crazy, it's just being patient. But I would say I would take at least 25,000 of that money, 25,000. I'd stash it away, and if I felt okay, like I could risk 5-10,000, I would invest that. But I think the important part is to see how you can set up your life so that consistently down the road you have everything in order. So at 27, or actually 26, 27, I had all my things in order where I didn't have to pay a mortgage anymore. I had enough passive income, and I had all this stuff lined up where I could leave my job and I could take on risks that I want to take on, like Airbnb. That Juggernaut's asking, where's my Airbnb? I have Airbnbs. Oh, F you. F you, Bear. Yeah, sorry, I just answered it. My Airbnbs are all over town. They're all over the metro area of Portland. So Portland Metro, all over. I don't like being. I had a couple. Actually, I have 2 inside Portland City. The cities are really, really stringent with their laws and permits, and taxes are obscene. So I don't like being inside them. I like being right outside of them. Okay. Let's see. Manuel, you've asked a couple times, so I'm going to do one for you real quick. I'm not going to go through that whole thing again because we're getting to 2 hours, but I'm going to go over, I need to do Intel, but I'm going to let you guys choose. Let me know. Do you guys want to look at AMD or look at Intel, or like at AMD or Home Depot? Which stock do you guys want to look at? Let me know. I've got both. Okay, I'm gonna choose. I'm gonna do Home Depot. So Home Depot. Let's see if we can pull it up here. Last one, and then I gotta go, folks. But thanks so much for watching today. So Home Depot right now is, I believe that it's overvalued. Okay, so I am giving it a $216 price per share. They're at 220, so they're trading right about at the same price. Oh shoot, okay. Everybody, a lot of people want AMD. All right, fine. You guys, I'll do both real fast. Home Depot, I love Home Depot. Home Depot is actually considered, what's it called? An essential business. So even during this lockdown or this quarantine or whatever, it's considered an essential business. And things are gonna get slowed down a little bit by them, but because of the overall market, the construction is gonna slow down. People won't have the money to buy new homes, so obviously new development won't be going up. But people will be still doing remodeling. People need to fix stuff. They have a large portion of Home Depot is actually subcontractors and smaller mom and pop like plumbing, shower door install type of stuff. And then every other person who just like needs like the little tools or the little knickknacks to like fix switches or light bulbs or lights, light fixtures and such. So there will always be a market for Home Depot. It's just how much of a market. And Home Depot, if you guys don't know this, is that they don't make a lot of their money off their tools or their lumber. A lot of the stuff is that their losses. And so what they do, they make a lot of money on are the screws. Those little tiny stuff is where they make a lot of their margins. So I think they're going to do just fine because that's something that you can buy screws from Amazon and such, but a lot of times I know this and I love buying from Amazon and saving money is I need to take my piece of wood or whatever I'm trying to screw together and I go to Home Depot and I walk up and down the bins trying to pick the right screw. And I try to see if it's too long, is the right width, is the right one, right? Home Depot is going to do just fine, but don't get me wrong, this social distancing and them only letting like 100 people in the store at a time is definitely killing their revenues. So right now with we see that their growth rate is right around 7% each year. I had them dip down to 3% for this first year and then, or not the first year, but this current year, and then it'll slowly go back up to 6 or 7%. Everything else I common sized just exactly what I showed you earlier. I common sized that out for each of the years. Let me just double check real quick my numbers are right. Otherwise, taxes, yeah, that's right. I made a couple of assumptions. Tax rate is at 33%. Let me just double check that. Yep, taxes across the board were very consistent. Average debt, they actually do have a ton of debt. So I don't know if you guys realize this, but over the last couple of years, they've restructured and redone a lot of their stores. They're doing a lot of that self-checkout stuff. They've reorganized the store. They've updated a lot of their equipment because they do have a lot of equipment inside the store for rentals. So they have a lot of debt and they don't have a ton of cash. Those are the two things that I don't really like. And if I was being honest, I'd probably give them only a 10 times multiple. I shouldn't give them an 11 time. I give them 5% discount rate. The market right now is giving them a 4.32, so I'm giving them a little bit more of a risk premium. And then, so that means that I'm giving them like a PE ratio of about 20, whereas the market is giving them a 23. And let's see. So they're right around $200 a share. So if they drop down significantly, I mean, they just dropped down to like, what was it, you guys? Was it like 130 or 150 2 weeks ago? I bought a bunch of Home Depot. I already sold it. I sold it at like 215 or something like that. So I made some good cash on that. They drop down again, I'll buy it again. Yeah, I love Home Depot. It's a solid business. I've personally, I mean, you guys can take this from anybody. As a contractor, as a builder, I've worked with Home Depot through their pro service desk. They're an awesome company. They're a really, really good company. All right, AMD. You're right. They do screw you on those screw prices, but it's because that's where they make their profits. I remember paying. I don't have any in here. Their lag bolts, their stainless steel lag bolts, are like $2-3 for each one. I couldn't believe I had to buy 50, 60 of them. It was so ridiculous how much I spent on it. Okay. All right, AMD. Let's jump over to AMD. Let's see where I put it. So Home Depot, I love them as a core business. I'll buy them up all day once their prices drop down. If you guys can see down here, if you guys see, I'm not sure if you guys can see this where I color coded it. I color coded companies that I will buy once they dip a little bit, and then I color coded the ones that I'm super interested in that are super overvalued, right? Meaning that there's an opportunity there if you're willing to short them and take a lot of risk. And so you can see AMD falls into it. Quick note, Nvidia and Chipotle are the two most overvalued companies that I have right now. Just something to think about. I think the Marriott is going to get hit really hard. And then AMD is actually pretty far up there. They're trading at a lower share price. Right now they're currently trading at $50. This is the insane thing, everybody. AMD is trading at 121 times their PE. They're trading 121 times their earnings, which is a PE ratio of 121 or 122. They have enough cash to cover their debt. They have 1.4 million in cash, 1.4 billion in cash, and they have only for about 500 million in debt. So they could cover it if they needed to. Let's see. I gave them an EBITDA multiple of 10 and a discount rate of 5. The insane thing is the market is giving them a 0.82 discount rate, which means it's significantly lower than just normal inflation, which is just crazy insane. I'll get into this here in a second. But basically, I common sized everything just like before that we talked about. And then I gave them a growth rate that's pretty generous, I think. Last year, they grew by only 4%. They had 2 monster years. I'm assuming that's from big contracts with all this AI. And then also, you guys realized in 2017, 2018 was when everybody was doing the cryptocurrency. Remember crypto mining? So Nvidia and AMD all shot through the roof. But that has kind of tapered off and even slowed down a little bit. And then that's why it went from 25% growth rate, 22%, and drops down to 4%. So I think with this slower year and people, 30% or 20 to 25% of people they're expecting by the end of this year to be unemployed. The whole country is going to be basically saving money, and most of these GPUs. For anybody that doesn't know, AMD makes processors and GPUs, and so I don't think a lot of people will be going out there building their own PCs, and a lot of the money, the revenue that AMD is going to bring in is going to be from the current contracts that they have. And so I think that it's very modest, or it's very generous to think that they'll have a 3% growth again this year, and then grow to 4%. And I think by 2022, as more AI stuff comes into play, more vehicles start having those touchscreens like the Tesla does, their business will grow. But even with a very generous 3 years and out, 10, 15, 20% growth rate, and then what happened here? Oh shoot, I messed up. I done messed up. Hang on, you guys. I didn't finish this. Yep, I did not finish this. Let me do this real quick. Boop. I must have gotten distracted. Okay, let me check out this common size. 45, 11%. Taxes. I'm being very conservative with taxes, saying they'll pay 10%, even though the last 3 years they barely paid less than 2%. So I'm being very, very conservative there. CapEx is right around 3.5%. Working capital fluctuates. Average interest. Their principal payments are all over the board, so I had to just make an assumption. But okay. So it makes it a little bit better. They are overvalued right now at $50. I think the fair price for their stock is $32. So if they get down to that area, I think they're good. Again, I've not dug into their 10K. I want more information on what makes up their business. You guys can do this too. Just type in AMD Investor Relations and everything will show up. That's all you need to type in for any company that you want to look at. Is type in the name of the company, Investor Relations, and it'll give you all the stuff that you need to see. Let's just type this in real quick in here. Let's take a look at what the professionals are saying. Another thing I like to look at too is like who's selling and who's buying. So the last year, a lot of their insiders have been selling their stocks, if you guys can see right here. Who are these? These are just individuals. So they're not board members or anything. So these are probably just like folks high up in the company, but they're not chairmen or anything. It's very highly institution owned. Okay. But let's look at the valuation real quick. So they're saying fair market value. They're saying it's undervalued at 54.74. Let's see how they got that. Let's say that we did a 12 and a 3. Yep, I disagree with those analysts. Unless they're coming up with some crazy cash flows or they see something different than I see. I mean, let's see. Well, what if we did like 5? Let's do 10, 15, 15, 20. Yeah. Not even if they had a 10%, 15, and then 15, 15, 20% growth rate, would I even hit that? Even if I drop this down to 3% and bump this up to 12 times. Okay. So for me to get close to them, I would have to use this crazy discount rate of 3%, which we didn't even apply to Disney. You wouldn't apply that to any of the companies outside of the for sure ones, right? 3% is insane. That's basically saying it's a for sure thing. An EBITDA multiple of 12. EBITDA multiple of 12 is reserved for very well-known companies. Like an Intel, I would give a 12. AMD, I probably wouldn't give a 12 to. I think it's very generous, very fair to give a 10. And then I think a 5% is better. But there's no way that their growth is going to be 10%, 15, 15, 20, 20% in the upcoming years, especially as we step into a recession. So I think a more fair one is 3, 5, 10, 15, 20. Yeah, it's 32. That's AMD, folks. Check out their 10K, check out their annual report. Use this as like a guideline. But I would say that they are but they're overvalued right now. If it drops down below, once it starts getting underneath 35, I'd be interested. I'd start buying them. Okay. Let's answer some questions and then I'm going to take off. I nearly suggested NVIDIA. They're riding the AI and the blockchain trends and so super hype. F you, Bear. Gosh dang it. You guys keep sucking me back in. Okay, F you, Bear. I did NVIDIA. I want to talk about NVIDIA. Hang on. Show. Gen A, 580 in Vegas, 64 were the shit for mining crypto. Bought a Vegas 64. Oh, so Jen, you mined crypto. Very cool. I've never done that. You guys, I was totally against crypto for so long. I was totally adamant against it. I even almost produced a video, but I thought I was going to get too much hate when crypto or Bitcoin went up to 20,000. I was like, this is a false thing. Yesterday, be careful. This is not an investment. Da-da-da-da-da. I'm starting to change my tune. I'm starting to look at Bitcoin now. I'm starting to look at crypto. Yeah, that's why I went with Mac. You guys, honestly, why I went with Mac was that the last couple of years was I wanted to build I used to build PCs. I actually had a business building PCs. And the RAM and video cards were so expensive. I'm like, I might as well buy a Mac so I can continue using my iPhone, iPad, and my Final Cut Pro that I use to edit my videos. Yeah, I think F you, Bear. I think if my memory serves me right, 120 executives from publicly traded companies were released, or they were asked to leave, or they stepped down from the position in the last year. It's really crazy. What is up, Noah? Good to see you. Good to see your face and your profile. Thanks for stopping by. Jen, tell me, why isn't crypto profitable mining wise now? Is it just the amount of power that it requires? Having right now. Bitcoin is having right now, meaning it's harder to mine it, so it's up to 9K now. It went down to 4K not too long. Yeah, it was. Which means that Bitcoin tracks the market. I think that's investor confidence, right? All right, so let's talk all about NVIDIA. You guys keep sucking me back in. F you, Bear brought up a good point. Okay, NVIDIA is probably my super interesting one. I used to build computers, and I love PCs. There's no thing between PCs and Mac for me. I love both. I just prefer an Mac for video editing and a couple of other softwares. I love iMessage, that type of stuff. But I have nothing wrong. There's nothing wrong. I actually think I have NVIDIA in here, but I have nothing wrong with PCs. NVIDIA, I used to put in all my PCs. It's a great company. It is probably one of the most hyped up, overvalued companies in the stock market. I say that with a little bit tongue in cheek, but I think Netflix might be it. NVIDIA's up there. Definitely like probably top 10, top 20 most inflated price right now. So you can see that it's trading at almost $300, which is so close to their 52-week high, okay? I've done everything to try to get close to that price, and outside of completely fudging and messing up the numbers, I can't even get close to it, okay? More realistically, they should be trading or valued at between 120 to 150 range, okay? Giving myself a little margin of error, even let's go crazy and say 175. They're trading at 300, okay? That's absolutely insane. Their PE ratio right now is 65, which means they have a discount rate, the market's giving them a discount rate of 1.55, meaning almost zero risk. That's not possible. That's not even possible. I'm giving them 3% risk. The reason is, F.U. Bear brings up a good point, is that they're stepping into AI and they're stepping into Tesla. Okay, they partnered up with Tesla, they partnered up with AI, and they had this huge cryptocurrency mining surge. And they really lead. I'm not gonna lie, they lead the way in graphic cards, and they will probably continue doing that. But I did dig into their 10K. I did dig into their annual report. Let me just read a couple of things that I actually made notes for. I wasn't expecting to get into this today, but that's fine. One of their board members, their advisory boards, Mark Stevens, who actually has an MBA from Harvard School of Business and also is a very accomplished advisor for multiple public companies. He's a VC. He's a venture capitalist, so he knows business just a little bit. He recently sold $30 million of NVIDIA shares in the last 3 weeks. He sold it all off real fast. Now I know that they schedule this out, but I can't help but see that he saw something. Why would he sell off so many shares so quickly, right? Usually if they want some money, they're trying to buy something. They're trying to buy a house, pay for something big. They'll usually like, hey, I'm gonna go buy a house next year. I'll sell it once. I'm gonna take one lump sum. When you see people or investors, whenever they buy in series, like 3, 4, 5 times, or they sell 3, 4, 5 times over the course of a few weeks, they're trying to either capture value or they're capture their gains, okay? I would never sell, let's say I had like 100,000 shares of a certain stock. I wouldn't sell all $100,000 tomorrow if I think it's a high. I would spread it out over a couple of weeks just to make sure that I capture as much value as I can. Does that make sense? So Mark Stevens, you guys can check this. It's all public knowledge. He sold it. They even said that they predicted a slowing down in the gaming market, and it reflected it in last year. They actually produced a loss in income. Oh, no, I'm sorry, not a loss. Slowdown. They didn't grow last year, and their stocks still grew, even though earnings went down. Doesn't make sense, right? The large part of their business is data centers. A lot of those contracts did not close. The volatile cryptocurrency market, it surged the last few years. It definitely died down. And then auto is going down. If you guys think Tesla is a great company, don't get me wrong. I love Tesla. I have a Tesla, okay? There probably won't be the entire market in a recession. People don't buy cars. We just know that. That's why they had to have a huge bailout in 2008. So that will probably go down as they are partner up with not dealerships. They partner up with auto manufacturers. And I think that their sales are going to drop. And that is completely isolated from the fact that we're about to go into a recession. And what happens when you go into a recession is that if I'm a big investor, a hedge fund, and let's say I have all of your guys' money, okay? I have I have millions and millions of dollars, billions of dollars. If I think that I might lose your money in this recession and I don't want to do that, I'm going to look at the companies that are the most overvalued and I'm going to sell those first, right? It makes sense, right? So if I'm looking at NVIDIA that's at $300 and I know I did my calculations, I'm like, it's only should be valued between 120 to 175 and it's selling at more than 2 to 3 times that, or close to 2 to 3 times that. I'm going to sell that one first. So all it takes is one investor, and if we jump over here real quick, we look at NVIDIA. Let's see how much of their stock is owned. Look at this. Look at how many people are selling within their company. See? That's all Mark Stevens. He just sold a bunch of money right here. Boom, 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 boom. And he sold it all last month in April, right? James Gaither sold it in April. Colette sold it in March. All these folks sold it. 1, 2, 3, 4, 5, 6, 7. What is that? Maybe $45 million worth of stock within 2 months. Why is that? Maybe they think it's at an absolute high. So take a look at this graph right here. This is for you, Effie Bear. You love graphs. 68% of institutions own, 68% of the shares are owned by institutions. So if I'm an institution that owns your stock or that has your money, I'm managing your money, and I see the bad recession coming, I'm going to sell the overvalued stocks first, right? Because I know that those are going to dip. They can't support a bad time. If one hedge fund, one big investment group sells NVIDIA, it's going to tank, right? I mean, it showed 2-3 weeks ago. I think it dipped down. What did it? You guys tell me. I forgot. It dipped down like 30%. What did it do? Where'd it go? Price. Show me the price. There it is. It dipped down to 196. Okay, so it peaked out at 308, 310, and went down 196. It lost 35% of its value in 10 days, 14 days. So imagine it's going to do that again. Look at this. And it's trading basically at its peak again. Let me get this closer. Look at this. This was the peak in February before the whole COVID-19 thing. And now it's trading. Look how close to the peak it is. It's so insane. So overvalued. Yeah, right here. Back in basically just last summer, it was trading way closer to its actual value. Here's another thing, you guys. Between this point and this point here, their business actually slowed down and declined, but their prices increased. So overvalued. Okay, enough of that. Okay, let's see. All right, I'm going to answer a few more questions, and then I really have to go. It's been over 2 hours, but I love you all for sticking around and watching this. You guys are freaking awesome. Okay. Bitcoin is having right now. I already saw that one. You get less rewards now for mining Bitcoin. Yeah, I could see that. There's no moat for cryptos until sober. You're right, F. U. Bear. It's like, you guys know what? Did I talk about this in one of my videos? China's going to be releasing their digital currency soon. I think they're going to do it probably within the next 12 to 24 months. If they do that, we as Americans, the dollar, the currency dollar, we're not screwed, but we're going to be in trouble. But I think America's going to do the same thing. Everything's moving towards blockchain. So if it's not Bitcoin, it's going to be the American Bitcoin, the dollar, or whatever. Or maybe we all use Chinese currency. But whatever it is that we know that countries are moving this direction. They're just freaking slow. Just think about the stimulus package. You guys still haven't gotten your checks yet. So it's something that's definitely going to happen. And it will be backed pretty soon by a company. But you know what? Do you guys know what asymmetrical risk is? And I don't want to say this and have you guys all run out and buy it, but I still need to research Bitcoin and cryptocurrency. Asymmetrical risk means that your downside is relatively low to considering your upside. Okay? So basically with cryptocurrency, what is it trading at right now? Bitcoin, Jen, you said $8,000 or $9,000, right? A couple of weeks ago, it was at like $4,000 or $5,000. Let's say that's even $9,000 right now. If you have it, $9,000 and it could go to zero. But with everything that's pointing at it, a lot of the evidence that's showing is the potential of it could be 100,000, 500,000, a million. Not tomorrow, not next year, not even 5 years from now. We're talking about decades. 20, 30 years down the road, it could be worth in the hundreds of thousands to the millions. So the asymmetrical risk here is that you risk $9,000. If it goes to zero, it sucks. You lost $9,000 over the course of 20, 30 years. Or you made $1 million plus. That's asymmetrical. And that argument that I heard from Raul Paul, who's this awesome guy, who's really somebody I watch, he mentioned that, and I was like, that's a very good argument. And so am I willing to risk $9,000 for potentially when I'm, 50, 55 to have $1 million? Maybe. Right? I have to look into it. Okay. I'll share some ways to gain crypto without having to mine in the Discord channel there. Yeah, Jen, share that in the Discord channel. Let us know. Now I'm super interested. FU Bear, pull an Elon and tweet out that their cards are back doors for CCP. Buy on the dip. That's funny. What's up, Larry? Did you check out... You know, Larry, I did not check out PBFX yet. Let me take a look at that right now. What is PBFX? Logistics. Now remember, as I say this, I like to invest only in things that I understand or know a lot about. Okay, so they're an oil company. What do you like about them, Larry? Tell me what you like about them. FU Bear, I'm way out on Tesla. Actually, SpaceX looks better with the new Space Force. I agree. I think Elon Musk is a con man. I don't know about con man. He's definitely, you've got to be a little bit different, right? If you're doing what Elon's doing. Call him whatever you want. Think whatever you want to say about him. The way that he's done what he did with PayPal, what he did with SpaceX, Solar City, Tesla, the Boring Company, you've got to give him credit where credit's due, okay? He wasn't a rocket scientist, and he completely changed the game of how we send stuff into space travel. Somebody with no space, I know that he has like a master's in physics or something like that, but you got to think like going from PayPal to changing and beating out NASA and the Russian government, it's pretty impressive. Changing the game of how car manufacturers, Ford, GM, Chevy, all these big companies that said that you cannot enter. It's impossible to gain entry into the car market. And not only did he do that, he kicked down the door, and now he's entering into semi trucks. He's completely changed the market. So I don't think he's a con man. I think that he's just different. He looks at things different, and I think that can both have. That can have negative effects and can also have positive ones. Hopefully, in the end, the positive outweigh the negatives. Random questions. I don't know how to pronounce that, but if I think Irma and Gonzo, is that team? I'm going to look it up real quick. Hang on. I don't know who that is, or I don't know what that is. I thought that was somebody else, but no, I don't know who Ting. Oh, do I know Ding Viet? Do I know how to speak Vietnamese? Yeah, I know how to understand it or hear it. I don't know how to speak it very well. I was just in Vietnam November. It got a little bit better. My Ding Viet got a little bit better, but not awesome. Okay, Larry, what are the chances companies start cutting dividends and partner distributions? Very high, Larry. Unless it's like an REI, a REIT, right? Or a company that has like historically paid dividends and partner distributions. A couple of REITs right now that I'm looking at is, I forget the name. The ticker symbol is O. The other one, somebody just sent it to me. I was researching it. I forget the other one. But O is the main one I was looking at. They've basically been giving dividends every quarter for the last 25 years through every recession, maybe even longer than 25 years. But companies like that probably won't. If they do anything and their margins really get hurt, they'll dip it down a little bit. But other companies, they'll straight up slash it. But you can take a look at their history really easily. Even in like, here, I'm in here right now. I'll show you. So this is the Realty Income group I was talking about. So if you jump in here real fast, and you go up to event indicators, dividends, click here, and then you're gonna go out. You see all those orange little dots? That's when they distribute dividends. And we go back, we know that there were, obviously we would probably have to do this differently so you can see it. But you can see 2009, they gave dividends, right? We knew in 2018 there was a little bit of a scare right here in 2018, and they still gave out dividends. In 2000, right? 2001 with the dot-com bubble, and then also 9/11, they still gave out dividends. So I would say that some companies are yes, a lot of other companies, they will slash it though. They can't afford it. FU Bear, that is a really good indicator for market time. What's a market time? Sorry, I missed that. FU Bear, what are you talking about? When you see prices rising when values drop, you're getting... Yes, you're right. Yeah. Fed coin? Yeah. Federal coin. Manuel, you guys listen, okay? Market, what day is it today? May 3rd? May 3rd. If China comes through with a digital currency, 100% you will see America do everything it can to circumnavigate that by creating its own digital currency or doing something completely unknown to not allow that to overtake and become the new reserve or the new standard for the global economy. Right now, the dollar is so strong because it is the backdrop for the global economy when it comes to currency. If China creates a digital currency for the yuan, it challenges that, right? He's like, yeah, with that blockchain technology. But I think that, to tell you the truth, I think what Facebook is doing with, what's it called, Libra, that's really interesting stuff. But yeah, I think it's very likely that Federal will come up with something. 8,900. 9K, $9,000, okay. Gen A, also crypto that is supposed to be equal to the dollar is called stable coins. Example is Tether and Facebook Libra. That's what I was talking about. Problem with Tether is they're printing Tether. So some people won't use it. Yeah, I don't like the printing thing. I don't like it when they're able to print it. I'd rather have less control. I really like Bitcoin, how it has to be mined. Larry, I work for a different pipeline. Oh, you work in the oil industry. Okay. And they're buying up all the pipelines around me. They bought part of my company and their dividend right now is a steal. All right. Let me go back to that one real quick. Larry. So it looks like Larry works for a competing company. Sorry if I'm blowing up your spot, but I don't think anybody will be able to find you. So let's take a look at this real quick. I'll do like really quick analysis. So they have a PE ratio of 5. Oh, that's the forward PE. Let's see what their current PE ratio is. Okay, it's 5. Let's take a look at their financials. They're buying up all the pipeline around you. The thing about this right now, in the short term, the entire oil industry is going to get slammed, right? They don't even have storage space for oil right now. And the entire market has crashed. Now listen, if you guys are doubting that the market's going to crash, let me just give you a perspective real quick. Oil crashed, right? Economy shut down. The Federal Reserve is printing money like there's no tomorrow, 3 trillion climbing. The corporate entities are completely over leveraged. I mean, look at all the companies I was just looking at. They all have tons of debt. And those are the good companies, okay? And then the last thing that a lot of people don't recognize is that baby boomers, this year is the average age that baby boomers are gonna start to retire. Not start, but they're basically all hitting between the age of 65 and 67. And what that means is when baby boomers retire, the next generation moves into the spot and they help lift up the economy, okay? That means Gen X and yours truly, millennials. we are not doing as well as the baby boomers, both in population numbers and in just financial success. Millennials, especially us, our generation, we don't have the financial success to invest in the stock market. So we're the next couple years, it could be a really, really tough time for our economy. I have no idea why I got into that. So with oil dipping, there's a huge oil crash right now. So it's tough for me because I don't really know oil that much, even though I did live in Texas and all my professors are oil dudes. I don't know much about it, but I can take a look at their books real quick and see how they're doing. So let's take a look at their cash flows real quick, like what I said in one of my videos. So we're going to go down. We're going to take a look at their operating cash flows, total cash flows from operating activities. So we're going to look at 2009. So they have about 150 million in cash flows. You take out their capex, they have about 120 million. Okay, so they're 120 million positive in cash flows. They have strong cash flows. Let's look at how much cash they have. So they're cash flowing and they have... Oh, I'm sorry. This isn't in billions. My bad. So they have 35 million in cash. Let me go back to cash flows real quick. This is... Oh, it is in billions. My bad. So they have 35 million in cash and they have 150 million in cash flows. Those aren't bad numbers. Let's look at how much debt they have. Ooh. 800. Okay, good. That's in millions. 802 million. Yeah, they have a lot of debt compared to their cash. Do they own? Okay, so you're saying that they're okay. That's right. You're saying they're buying all the pipeline and property around you. So they own a lot of land. So it looks like they own like $116 million worth of land. They own 200 million in machinery. They own almost 650 in other equipment. So they own almost $1 billion in stuff. So I bet you what they're doing right now, Larry, is they are actually doing pretty well cash flow wise. They've got cash. They've got some loans. Let me see something real quick. They are probably doing really well business wise and operationally. They're probably really sound. And what they're doing is they're consolidating the market. They're going out there and they're buying all the small companies that just can't afford to hold on to whatever it is they have while the oil industry is tanking. Let's see. I want to go to health. Yeah, look at all this debt. So the red line right here, you guys, if you guys can see that, let me scroll it. Usually you don't want to see these two lines separate between the debt and the equity. And they're separating right here, which means that they're probably taking a lot. I mean, it's a ton right here, 2019, then 2020. Nope, sorry, that's all 2019. They've probably been planning on expanding or buying up a lot of other people. That's just a lot. That's a lot of debt, though, compared to what they have. Yeah, I don't know. It might be something worth looking into. Long term, I'm not really bull on oil. I think that in the next 5-10 years, it's going to be a major shakeup. Sorry, Larry, if you've been working in that field for a while, but I think that there's going to be a big shakeup in how energy is going to be used and sold, and I don't think it's going to be in oil. So, but in the short term, it could be a good buy. Where are they trading at right now? I forget. There's like 13 or $8, $9. What did their prices do? I mean, in the short term, I'll tell you this: oil's not going to go up for a while. Okay, oil's going to stay down for a while, especially if we go into recession. If the economy opens up, planes start flying again, yeah, we'll see a little bit of a recovery. Long-term wise, I don't know. I mean, shoot. Larry, if you have some money and you're okay tossing some in here, I mean, you could double or triple it within like 5-6 years. Yeah, if you're okay lose, just keep in mind the money that you put in here, it's you're okay losing it, right? So if that's $1,000 or it's $10,000, it might not be a bad buy, but very, very surface level, their numbers are good. They're decent. I don't like the amount of debt that they have, but they have some cash. They cash flow fairly well, and right now their price to earnings ratio is really rather modest, 5%, or I'm sorry, 5x, 5x, which is, let me see, what is that compared to the industry average? Valuation. Their volatility is very high, so they're smaller. Where's the industry average PE ratio? I mean, right here, even Larry. So analysts right now are saying that it's valued at $25. I would have to run a full analysis, but okay. So right here, PE ratio is at $5. The oil and gas industry average is 10, or $5, 5x. Sorry. And then the U.S. stock market's at 5. So yeah, you could double it. You could double it. You could triple it. I don't know anything about oil though, so I would probably stay away from it personally. But if I saw this type of these type of numbers for like something that I understood, a business I understood, I'd probably invest. Okay. Yep. Exxon dropped it. Do you think real estate is? Jen brings up a great question. Do I think the real estate market would crash as hard as 2008? I do not. The stock market will not crash that hard. And the reason why it won't crash that hard is 2008 was very concentrated in real estate, especially subprime mortgages. And so what ended up happening was two things were happening. Everybody was it was called predatory lending. I don't know if you guys remember this, but basically mortgage brokers and anybody with a pulse, they would just go out there and give them mortgages, right? And they would give them mortgages with these ARMs, which are basically adjustable rate mortgages that would balloon or transfer over or adjust within 1, 3, or 5 years. And the reason why they were doing this was because you could get somebody in who made no money or very little money and get them a $200,000, $300,000, $400,000 home with zero down and like interest rates in the 2 to 3, 4%, which was insane at the time. Okay. But what happens is that you get that introductory rate, and then in year 2 or year 3 or year 5 or 6 or whatever, your interest rate would go back up to whatever prime was plus 1 or whatever it was. At that same exact time that all these ARMs were adjusting, the Fed was raising interest rates. So all these people that were paying like 2%, all of a sudden had to start paying 6%, 7%. And you guys know how mortgages are. Between a 2% mortgage on a $300,000 home versus 7% is you're talking about several hundred to maybe $1,000 plus. And so that's what caused it. And so all these people under predatory lending and all this stuff, all their homes went up for sale and foreclosure. This time around, it's not going to be that bad because it's not focused on that. What you're going to see is going to be a lot of people like maybe folks like me who own many or several duplexes, triplexes, Airbnbs, and they over leverage themselves. So basically, if everybody can't pay their rent, but I still have to pay my mortgage, I can't hold on to them. So then I have to give up the homes, or I have to, foreclose or short sale or whatever I have to do. And so you're going to see more of that. So it's going to be it's going to be more niche in this recession. But overall, we will see a softening of the real estate market, but it won't be like 2008. Unfortunately, because I'm a real estate guy. But when I say all that, I do think that there will be deals. The deals will come after it'll come later. It will lag behind the stock market. So whenever the recession really hits us in the stock market, you got to wait maybe 12 to 18 months, and then real estate will catch up. It's just kind of like, that's one thing that we can take away from the last recession, is that everything started going down the market in 2007, 2008. And I remember this, you guys watched this in a previous video, is that I bought my home in June 2007. August 2007, I started getting phone calls and all this stuff, people saying like, hey, you shouldn't have bought that home, or you shouldn't have done this. I'm like, why? You're like, you bought at the peak, da 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 da. Did you see this happening? I started getting these letters. And then by January 2008, everything went down. So, but the best prices, I bought at the bottom. You guys, I bought at the bottom. I didn't get the best price though. At the very bottom of the market, June 2009, I bought my luxury condo downtown that everybody would want. I was 23, 24 at the time, and I bought the most coveted spot, like 2-bedroom, 2-bath, like penthouse style condo in the middle of downtown, right? And I was like, dude, I made it. This is the best deal ever. It took until 2011 for the bottom to really hit within the real estate market. 2010, 2011. So if I had to do it all over again, I would have waited like another year probably. Long story short is that the market will always lag behind the stock market, because the stock market just moves a lot faster. Real estate, you got to wait for people to lose their jobs, go out of business, unemployment to run out, all this stuff, and then they have to put up their homes. Okay, enough rambling. Manuel, you're 10 years old? Dude. It's good that you're listening to this though, Manuel, because if you're paying attention now, you can learn from that. I lived through it. I was 21, 22 years old, and I was able to make enough money, and now I'm implementing what I learned. If you can listen to like what us old folks are saying and what other people are saying, you can make a lot of money off of this next recession. We all hate the young, right? Okay. How often do you do these live chats, Jaggernaut? Hey man, I just started this back up, so I'm just getting a feeling for it. I've had a bunch of you ask about stocks and valuing companies, and I wanted to give you guys more value. And you know, I'm going to air out a little bit here, is I see a lot of folks on YouTube doing financial education, and it just really, really, really irritates me. I shouldn't say that. I come off as a hater, and I don't want to be a hater, is that because I see folks like you who are really eager to learn, and you have other YouTubers out there who are talking from opinions, and they're talking from, not to be mean, but uneducated perspectives and standpoints, and like they don't have experience and stuff. And I'll be the first to tell you if I don't have experience in something. I don't know how to do forex trading. I don't know how to do day trading. I don't know how to speculate. I don't know how to do commercial real estate. But the things that I do know, I want to educate you guys on. And I did fulfill what I was trying to do: live minimalistically, build my own house, live freely, become financially independent, and then be able to do whatever I wanted to do. But with there's a lot of misinformation out there. So I just really hope, even from me, like I don't give you guys misinformation, or I don't do it intentionally, but I want you guys to question and think about what you guys hear from us. And there's a lot of YouTubers out there that are just feeding you nonsense. Like, hey, I traded, buy these stocks now. These are the most underrated or most overvalued stocks. Unless they're doing something very similar to what I'm doing, and even what I'm doing here, it's not absolute. It's a method of thinking. It's a method of how to value something to see. And if you're right 8 out of 10 times, 7 out of 10 times, you end up being up in the long run. So I want to start doing these live chats. Long story short, sorry Larry for going on a tangent here, is that, or Juggernaut, not Larry, is that I want to give you guys some good tangible information. And a lot of you guys have been asking about this, and I don't want you guys to get messed up or screwed over in the stock market. You guys asked a lot of good questions. Like Jen earlier asked if she has $30K, should she invest it? How should she invest it? You know, for me, I probably would. If For somebody in Jen's position, and you were my good friend or my sister, I'd advise you to save a large portion of it, and then if whatever portion you felt comfortable losing, I would use that to invest. That's how the game goes. Okay. Oh, so how often I do these live? Sorry, check it out. I'll do these live chats probably. I'll try to do it once a week. Yeah. So if you guys hit me up in my comment section or any of the polls that I do, I'll try to come on and do something like this, and I'll come back and if you guys have, please send me stocks or properties or real estate, and I'll pull them up, and we'll do full we'll do full analytics on them. And if you guys really like it, we'll continue doing it. Larry, I think pipelines are rock solid for the next decade. After that, I am concerned. Price per barrel doesn't matter. We still get our share for pumping no matter what the price. It's set by the government. That's interesting, Larry. See, I don't know that. And that's the thing with investors, is that I only like to invest in things I understand. You understand that. I think that if you really see a good deal and that you think that governments will still keep subsidizing that and paying for that, you should do it. All I know as a random consumer and citizen is that oil doesn't have a lot of places to be stored right now, and there's not a high demand for it. And so my question would be, in the next 2 to 3 years, if there's not a big demand for oil, considering that airlines are hit or even a major airline goes out of business or like traveling is shut down for the foreseeable future, is who's gonna pipe oil and who's gonna pay for it? That's my only question. Let's see. FU Bear, if you are 20 years old, just buy like 50 or 100 bucks a month, every month, and spread it around, or put it all in 30 years, you'll be okay. Yeah, FU Bear is absolutely right. Manuel, if you just keep on pumping money into the stock market and you spread it across, Warren Buffett really pushes this. It's like buy index funds. He really pushes the S&P 500. I personally always invest in VOO. It's the Vanguard that tracks the S&P 500. You do that long-term wise, you'll be just fine. I think for the last 50 or 60 years, the average rate of return is like 10% when you add in dividends. So it's not a bad idea. Okay, 3 hours. You guys kept me here for 3 hours. Thank you so much. But hey, I really appreciate you guys all staying and watching. If you guys haven't yet, help me out with that thumbs up. I think it really helps the algorithm. All the comments and everything, that also helps a lot. And I appreciate you guys and gals listening to me rant and watching me go through this. And I hope it was helpful. If you guys have any feedback, questions, or anything like that, please hit me up. Discord, you guys can reach me there as well. Other than that, you guys take care. Oh, I gotta tell you guys to buy something. Let's see. What should I tell you guys to buy? I already told you guys to buy a water filter, buy a bidet. Let's see. Buy a good tool set. Yeah, that's a good one. Good tool set. Hammer, screwdriver, tape measure, stuff like that, so you can do some basic stuff around the house. It's so crucial, so important just to be able to fix your own stuff, so you don't have to pay somebody else to do it, and you never know when you actually need to hang up pictures or fix random stuff, toilet, whatever it is. Understand how to do the basics. It'll save you a ton of money. Other than that, love you all. Peace out. Kai out.